So my name is Luis Seco. I'm a professor at the University of Toronto. I am a professor at many other universities also, in Germany and here in Kutaisi. So I taught this same course last year, and I'll be teaching this course this year. I also teach other courses. Last year I taught a course on data science and machine learning. I suspect I'll be doing the same this year. And perhaps more interestingly, I taught a course on communication skills to the previous class in Munich. As you may know, the students had a study tour in Germany for 2 weeks, and I was there with them, and we had a session on communication skills. Okay, I have done many things in my life. I'm a professor, but I've also managed an investment company for 20 years and other things. And because of that, I like to bring my experience to you. That's why I'm here. This course is going to be a summary of everything I consider to be of interest in this area of finance and information management that you're coming into this. I have, I'm going to include topics of different things. You will see that my course is very varied. I will talk about business and finance. I will talk about math. I will talk about technology and computer science and practical implementations. And I would like to spend some time on communication skills. Now, this is something which, if we repeat the experience of last year, we'll have a dedicated 1-week session to that. Maybe it will happen, maybe it will not happen. I don't know, it's not up to me. If it was up to me, it was going to happen for sure. But I may spend some time on that. I like my course to be helpful. And I know how important these things are. And I may even discuss things about ethics and professional behavior, something which is not often discussed in programs like this, but I know how important it is. So I'll try to perhaps talk about that. This course will have 2 parts. First is going to be live. I'm going to be here today, tomorrow, until Monday at noon, and right after I leave. So we're going to be together, and I will try to make my course very interactive during those days that we are here. I have a principle. I know it's impossible to learn anything unless you learn it on your own. So I pretend I'm here to teach, but it's not true. Anything you learn, you have to learn on your own. So I want to be here to help you in that journey of learning. When I'm not here, it's a bit more complicated. We'll have some team sessions, and so I would probably save some of the more technical things for that, because then I will be less useful, I think. But we will see. We will see. I had a very good feeling for the course that I taught last year, and this year will be even better because I have already made a few mistakes that I don't need to repeat. Okay? So I'll leave some technical aspects to that, and the course has a website. I like to have a website of my own where I put things that may be of use. I'll show it to you. Maybe you've already seen it. It's on my own personal website. And this is where we can exchange things. We can exchange lecture notes, we can exchange videos and this and that. KIU has a very convenient Teams environment, but I was notified that they're changing into something else. I don't know what it is, so I'll learn it. I find universities in general to be still discovering how all of this empowering from technology works. So I have my own system and I like to use it. So I'll show you and we'll talk about that. Okay. And you're always expected to participate in classes. As you're going to find out today, this is not a course where you sit there, I speak, and you listen. No, it's not like that. And I'm telling you, that's not how you learn. That's how you pretend to learn, but that's not how you learn. So we're going to conduct discussions. There will be a lot of discussions today. In fact, most of today is going to be just a discussion. You will have to participate. You'll have to do things. And I like to do role-playing exercises. I like to pretend that you're someone you're not, and then we do things. All of that is going to happen today, so no mysteries there. Now, in fact, the first thing that I want to do when I start with a discussion, I want to know why you're here. So I want to go through you. When new people arrive, I'll do the same thing. I want to know your name, your background, anything you consider to be relevant about your life. But you have to end, please, with why you're here. So my course is Introduction to FIM. That's what this course is about. And what I want to do is I want to today focus on the math of business. And for that, I'm going to be starting with business. From my perspective, business always comes first. Math comes next. Okay. Sometimes the math is so beautiful that if you like math, many people are just attracted to the math. But I always try to stay focused on what matters, which is the business. Okay, the business. And I'm going to do that by today talking about what I call the life cycle of financial products. You know about finance? Finance makes it to the world through financial products. And I want to tell you about financial products, what they are, and this and that. But I'm going to do that from the perspective of their life cycle. The life cycle is, we're going to start with how they're conceived, the conception, which is the idea. This is very important because they tell you why something exists. For example, you traded stocks, I assume. Yes? Okay. What is a stock? Why were stocks created? Do you know?
I have an idea to provide financing to companies.
They were always created to provide financing to companies. When were stocks created?
I think before 19th century.
So they were created during the Industrial Revolution. The Industrial Revolution, there's going to be a lot of history in my course because it's very important to understand why things are the way they are. The big change that the Industrial Revolution brought to humans is that suddenly you had enterprises. They were too big for one person to do. Up until the Industrial Revolution, you had your business. You were a baker, you had your ships, you had whatever it was yours. And you and your family, typically the family was involved. You and your family were the ones operating that business. Think of agriculture, right? During the Industrial Revolution, that ended because people suddenly could do much, much more, but they needed to get together in groups. That's why in English they're called companies. I don't know how you call them in Georgian.
Compañía.
Okay, so same thing. You meet someone and when you do that, right, when you get together with someone, well, you have to figure out a way to share the cost and share the benefits. That's what they call shares or stock. And they all started around the 1700s, around the Industrial Revolution. It was a way for people to be able to work together and then sharing the gains. And this created shares. This is very important to point out because so many of my own students in Canada think that stocks is something that you buy low and sell high. Never people thought this is something that you buy low and sell high. In fact, most people don't like to sell stocks. Why would you sell a stock? Right? It's part of the what you own, it's giving you dividends. People typically don't want to sell stocks. The idea of selling stocks is crazy. And in fact, the trading that I suspect you do is trading which is very outside of the financial sector, because the financial sector typically is about creating wealth, not so much trading. Trading is typically a very small part of the financial sector. To understand all of that, I want to go through an example today. And then, of course, trading is fine. People have to do it, right? But I want you to understand a lot of that. And a lot of that comes to the why. Why do things exist? Why did companies, why do stocks exist? They were not just suddenly some politicians, oh, let's do a stock market. Oh, then people can buy and sell. Oh, then we charge taxes. No. It was never like that. One of the first few companies, I love to talk about this, one of the first companies created with this new concept is a Canadian company that went bankrupt last year. It was a company, today it's called the Bay, and it was just a supermarket, a department store. You go there and you buy clothes, you buy appliances and this and that. But the company is called the Bay because the original name was the fur import company from the Hudson Bay. The Hudson Bay is a part of Canada which has a lot of water, and there were a lot of seals. You know seals, the animal? Okay. So there was a company that was go there to kill seals, get the fur, and sell it back into the European market, which loved seal leather. So, and then eventually it became it became a department store. But it was a company created by British men, okay, who got together and said, let's go get some seals, bring it back, and make a fortune. And that's what it was, right? It was, again, people getting together. And that was in 1685. I like to ask this question to people in Toronto because every time you walk in front of the Bay store, they say established 1685. That was before stock markets. So you could buy the stock of that company, but you couldn't really sell it except on a bilateral transaction. Stocks came after that. So it's a company that predates the stock markets. So that gives you some idea, right? Okay. Now, today we're going to think of that, but of course in a more modern setting. I'm not going to do a course on history. But we'll talk about that, which is the why. And then we'll talk about the birth, when they're actually born. In fact, today, we are going to create many financial products. And in fact, we're going to create an investment fund. And you will see why we need to do that. And then you'll see how we do it. We're going to do that today. Today, we're going to just do all of history, everything that happened since the 1700s, with one example. With one example. We're going to create a company also, okay? Then we're going to see how this grows and how things go well, and then we'll see the risks, things to avoid. We're going to do that. We're going to do role playing for that reason. And then we're going to talk about death, how things die. And that'll be the end of it. That's my plan for today. Once we see that, once we understand the business, you will see there's a lot of math into that. And then the interpolation between the business and the math is what this whole program is about. One could say that the whole program, the whole theme program, is to understand the example I'm talking about today. You will see there's many ramifications, many what ifs, and many questions without answers. All of that is why FIM exists. So I like this example a lot. I've been doing it for 20 years. When I came up with it, I thought it might work, and every year I discover a new fold. It's something that I create. I made it up, but it works. It works very well. Okay? So that's what I invite you to do today. Now, in terms of timing, because everything was so strange, I was supposed to start at 11, I came at 12:30. What I would like to do is I would like to plan our discussions, our breaks, and this and that. So, so it's 4 of you here today. I don't expect anybody else later. No? Maybe in the weekend, some new. Sorry?
One girl will come
One person will come later, right? Okay. Do you have an idea what time?
At 3, 1.5 hours.
At 3. We'll come at 3. Okay, so how about this? How about I start now for half an hour, then we can take a 1 hour break, and then we continue at 3. That give you time to, I don't know, what's your lunch time? Or you had lunch already? Or you're flexible? No.
Whatever you prefer.
Okay, so I'll lecture for half an hour, maybe a little bit, maybe 40 minutes. And by lecture, I just say, it's not real lecture, we're just gonna talk to you. All right? We're gonna build this together. And then at some point I'll stop. I'll make sure that the person that comes at 3 can catch up with us, because she will have to be part of this. Everybody's gonna be part of this. We're building this together. Okay? All right. So this is, okay, so let me do that. This example starts from one thing I heard around the year 2000. It's a very nice concept, and it's also entertaining. So I'll start with that. It has to do with the city of Montreal. And look, I don't know, maybe you've seen this example already. It's on my YouTube channel and this and that. Maybe you've seen it, maybe not. By the way, I told you I have a course website, but I'll talk about that not today. Maybe when more people are here, so they get to listen to that too. Okay, so of course you can go to my website and it's there, but I'll explain that when more people are here. It has to do with the city of Montreal. The city of Montreal has a very interesting challenge. You can imagine that. Not this particular challenge, but you can imagine every city, every entity has financial challenges. This is just one example. And that is cleaning snow. Montreal, unlike Kutaisi, has a lot of snow every year. And cleaning that is very expensive. The city spends well over $100 million of real money cleaning up the snow. Okay, so all right, so you clean up the snow. What's the problem with that? The problem is this, that the cleaning, imagine that you have the city that wants the city clean. If you don't clean the city, it's a disaster. You cannot deliver food, and the city does not work. Canadian cities with snow, they shut down, very bad. Okay, so the city said, well, who's willing to clean this? For $100 million, you can imagine many companies will be happy to clean it, right? $100 million. But companies, they don't really like to do this, except in one particular case, which is, imagine this, who wants to, for a few minutes, who wants to be the owner of this company? Who likes to clean up snow? You are, okay, good. So you're gonna make $100 million, and I'm the city of Montreal, and I negotiate with you, right? Say, come clean the city for me. Then you start to do your calculations, and then you say, okay, what does that mean? I say, well, whenever there's snow, you clean the city. I say, okay. And then you're gonna have to hire people. You're gonna have to have equipment ready to clean up snow and this and that, right? And then you say, well, you have monthly costs, right? I'm gonna pay for that, but imagine that you have snow in October in Montreal. It's possible. Today, it's possible it could be snowing in Montreal. So what does that mean? Do you have to have people at your company ready to go and clean up snow if there is snow in Montreal in October? Right? If I
am hired as a company, I should make clean.
You should clean the snow, exactly. So the month of October is going to be very expensive for you because you have to hire people, you have to have them ready, doing probably nothing, right? You understand?
Why not hire? If I am hired, maybe city gives me money.
I know, exactly. So then you're going to charge me for the month of October. And I'm the city of Montreal. I said, you're charging me $20 million to clean up the snow in the month of October? No, It's too expensive for me now, right? Of course, you'll be very happy to charge me, but if I'm the city of Montreal, I say that's too much money. You understand? In January, there is no question. You charge me 20 million, I said, oh, that's a great deal. I give you 20 million and you clean it, you hire people and everybody's happy, right? In August, there's no question. There is never snow in Montreal in August. So I don't want it, you don't want it, no problem. But imagine a month, October, November. Do you want it in November? It's a decision I have. It's a tricky decision for me. It's going to cost me maybe $20 million, right? And maybe I don't want to. You certainly want certainty from me because you're going to have to hire people. I have to pay them, right? You don't care if you pay them to do nothing, but if you pay them to do nothing, you have to charge me, right? Right? And I'm the city of Montreal. $20 million is a lot of money to clean up maybe nothing, right? So I have to make a decision. Do you understand? It's a difficult decision because you cannot predict the weather. Anyway, as I'm talking about this, you can imagine this thing in agriculture, in many, many areas. I'm going to focus on this example because it's very interesting, right? Understand? So then this is an issue. The company is happy, but the city needs to decide when that should work because this is a picture of snow cleaning in Montreal. Everything you see there, the snow plow, the truck, they all belong to you. They don't belong to me. It looks like the city is cleaning. The city is not clean. The city is just paying you. You do that. Right? Okay. So, all right. So we've gone to that. It's very expensive. If, for example, it happened in Toronto in 2003. In Toronto in 2003, we had snow in April. April is not part of the Toronto contract with the cleaning company. And we had snow. When we get snow in April, what we do is we wait. Because typically in a day or two, the sun comes up, there's rain, and the snow just disappears. So maybe for a few hours we're in trouble. But the city of Toronto has decided that April is not on the contract. In 2003, after 3 days, the city of Toronto had to call the cleaning company because it was a disaster of the city. It couldn't deliver food, it was bad. The cleaning company charged the city of Toronto 1/2 of the next year's budget for one cleanup. So charging $50 million for one cleanup. But you have to hire people, they're not available, they're doing other things, it's very, right? Very expensive, and you know, I have nowhere to go, right? You make sure it's very profitable for you. That's how finance works, right? If you really, really need something and I have it, I'm not going to give it to you cheap, right? So that's an example of, if you can say, no, I don't want clean, I want to save money, but if you need it, it could be very expensive. So you have it's an interesting problem. It's an interesting problem. The city wants to save money, but they're taking risks to save money. The companies are just happy. Okay, so someone had an idea. Turns out that the snow has another impact, economic impact in Canada, which is entertainment. We have very profitable ski resorts. This one is Mont Tremblant. This is a picture of Mont Tremblant, which is a ski resort near Montreal. Do you ski?
Yes.
You ski?
We have also very good ski places.
Okay. So you know about ski resort. You've been to a ski. You have
Yes.
skied. Yes, yes, you have skied. Okay. So just to give you an idea of the magnitude, this is just a partial picture. It's the best I could get. That looks like a hotel, right? The whole thing is a hotel. In fact, all of that you can see, that everything is owned by one company. Everything. You can go to that hotel, you can go to that hotel, you can rent an apartment here, you can go have dinner at this restaurant. Everything is owned by a company. It's a big business. Imagine this big business with no snow. Sometimes at Christmas time is high season for this. It's full. A few years ago, at Christmas time, there was not one snowflake. Mud. Only mud. What happens when there's no snow here? Big losses, because you have to hire everybody. You have people there waiting, doing nothing. No one came. But these people are employees. They get paid. Right? So a lawyer had an idea. I said, it looks like they have the opposite exposure to snow than the city. So why don't we do a deal? This is the beginning of, this is what I call the idea, the conception. When you do a deal, you start coming up with a financial product, okay? So the deal is this. I'm gonna do what's called a swap, a snow swap between the city and the ski resort. The idea is you tell the city, no, don't pay, save your money, okay? And this is what happens. If we don't have snow, then the city said, oh, great, I saved $20 million. I'm very happy, right? But then the ski resorts, damn, I have all these employees, and what can I do, right? So I said, don't worry, you're gonna give them some money. I pick a number, 10 million. I actually don't know what number was proposed. A number was proposed. I don't know what it was. I'm gonna say 10 million. Then the city said, oh, okay, I saved 20, I paid 10. Well, let's assume that it works. Okay? In fact, we're going to do some calculations. When we do calculations, I'm going to bring that down to a unit of 1, which is easier to do math if things are 1, right? So there will be a unit of 1. But don't worry about that. So some money, yes? But then, this will be very expensive. But it'll be cheaper if I do that. I say, if there is snow, you actually get snow. The city said, oh my God, I have snow now. I have to call the expensive cleaning company. Say, don't worry, because now you're getting $10 million from the ski resort, who's very happy to pay you. You see? The ski resort is all my rooms are full, restaurants are full, $10 million is nothing. Here you go. But when there's no snow and I'm struggling, I get the $10 million. So I get money when I need it, and I give it when I don't. It's a good idea, right? It's a very clever idea. Okay, well, this is finance. This is how finance happens. This is very cold for me. Is it cold for you? No, you guys are okay.
It's cold.
You okay? I'm gonna put this down there. Okay, so it looks like a good idea, right? It was great. The ski resort loved it. The city loved it. I don't know what the numbers were. Doesn't matter. I want to go with these numbers. They loved it. It was great. And the contract was done. And the city and their lawyer show up one day. And the ski resort and their lawyer show up one day. They're all sitting here. And I'm the happy lawyer broker. I'm probably going to make some money out of that also, right? And then one lawyer, I don't know which one, said, there's something missing here. I need a clause that specifies the location where I measure the snow to determine if I pay or not, right? What do you think happened? What do you think happened?
You fail?
They did not agree. They could not agree, in fact. The deal died. The deal died because they could not agree on where to measure the snow. The city wanted to measure the snow in the city. The ski resort said, the city, no, I'm measuring the ski resort. She said, ski resort, I don't have to clean the ski resort. I have to clean the city. They didn't agree. Happens all the time. Okay, all right, so this happened 2003. But now, we want to take this step higher. Everything that you have seen here, this is how finance works. There's no real mystery here. But now we are going to become smart. Imagine I was there. Let's say let's say I was there for some reason, just observing. And they said, no one leaves. Please sit down. This is my idea now. And with this idea, you're going to see how much money I make. Just watch. He said, everybody sits down. Don't leave. I understand your issues. They're probably fighting at this time. The ski resort, the city, ski resort, city, I don't know. Everybody sits down. I will propose a different deal. This is my deal. Okay? Now you can imagine, you can choose. To imagine this, you can assume you're the city or the ski resort or the lawyer. It doesn't matter to me. This is my proposed deal. Slightly different, but it's better. What I want to do is this. I'm going to talk to the ski resort and say, do you want to measure, who's the ski resort here? You're the ski resort. You're the ski resort, you want to measure at the ski resort? You measure at the ski resort. Fine. If no snow happens at the ski resort, I'll give you money. I will give you money, me. But if snow happens at the ski resort, you give me money.
Oh, you're the middleman.
I'm the middleman now. Okay? Maybe you look at me and say, do you have the money? Say, oh, I have the money. 20 million right here. She said, okay, that's good. I liked it before. Fine, thank you for that. Sir, thank you. Then I go to the city, go to the city, and I tell the city, you wanted that measured at the city, right? I give you that, and I give you the money. Right? They're all happy. You got what you wanted, no point in fighting. I step in, I give you what you want. I don't do it for free. I'm going to charge you 10%. I was an observer, I know 10% is a small amount. I'm going with 10% because I want the numbers to be simple, not because it makes business sense, okay? Just 10%. He said, oh, 10%? 10% is not. Are you sure that I'm measuring at the ski resort? Yes. Are you sure I'm measuring at the city? Yes. 10%. You're happy? You're happy? Am I happy? I'm going to collect $2 million on average. 10% of 10 plus 10, 20, 10% is 2 million, right? Sounds like an easy way to make $2 million, no? What's the problem?
What if both was...
There's no snow in the ski resort, and there's a lot of snow in the city. I'm screwed. I have to pay $20 million minus 2, $18 million. Not so happy. Right? But it could happen. A ton of snow at the ski resort, no snow in the city. Take. I make $22 million. What do I do?
You go to other city, to other ski resort and do the same.
You're right. In fact, that's what I will end up doing. But first, I need to do one thing. I need to analyze if this is a good investment or not. Because now I'm working with a lot of numbers, right? It started very easy, $10 million insurance. Then I said 10%. Oh my God! Now you see, it gets complicated. Suddenly, it gets complicated. Because now there's a lot of numbers floating around. There's the 10 million, the 2%, the 10%, 2 million, right? Is this a good deal? Let's start with that. Is this a good deal? I understand we can go to other cities. We're going to do that, okay? But before we do that, let's analyze this deal first. Is this a good deal?
I don't think so.
Do you have any?
It depends on we can check out the seasonal, the snow levels for past 5-10 years.
Yeah, exactly. So now you're thinking like a data scientist. You're thinking, wait a minute, everybody, go home, come back tomorrow or something. Stay there. Let me check my numbers. You're thinking like a data scientist. I'm going to download some data from this and that, and right? Imagine you can do that like that. You have a ChatGPT right there. So quickly, tell me, right? Now you're thinking like a data scientist. Congratulations, we just brought data science into finance. Yes? In fact, let me tell you the answer. Let me be ChatGPT for you now. Use ChatGPT here?
Of course.
Yes, good. You have to use ChatGPT. Okay, so let me give you some numbers, okay? Let's say this is what ChatGPT gives you. I'm going to give it to you in a way which is friendly to our discussion. ChatGPT will give you something different. So I'm going to put it like this. I'm going to assume 50% correlation between the two cash flows. You know what correlation is, yes? Okay? Correlation means that, well, they tend to happen. Of course, there is no exact alignment, but there's a pretty good alignment. We will understand correlation very well in my course, by the way. In fact, we'll understand correlation very well today, intuitively, not just the algorithm. No one understands the algorithm, the concept. Okay? So 50% correlation between the two. What does that mean? I don't know how good your probability is. You come from the business side of things, okay? But if you took a course in probability, in fact, I love to ask this question in probability courses, which is with 50% correlation. So imagine I have 2 coins. I don't know if you know this project. I have 2 coins. I don't have coins. I have 2 coins. And I flip them. They're independent, right? Coins are independent. If they're independent, what's the probability I get heads and heads? 1 over 4. Heads and tails?
1 over 4.
Tails and tails?
1 over 4.
And tail,
That's a nice.
1 over 4, right? If they are 50% correlated, what's the probability I get heads and heads? Should be higher. Right? Should be higher. Higher than 25%. What is it? Do you know what it is?
33, maybe?
Huh?
33%.
No. No. Okay. So you don't know. But would you know how to do that? Would you know how to do that? I give you an exam right now. There, exam. You pass this course if you answer that. Would you know what to do?
Yeah, I know. So the final result would be the probability.
Okay. I'm not interested in the answer. I just want you to tell me if you would know what to do. Possible answers. I asked ChatGPT. That's a possible answer. Another possible answer, I'm going to write a simulator with Python very quickly, and then I look at the numbers. Or I'm going to do it by hand.
I think probability wouldn't change.
No, it does change. It has to change. Because now these coins are... But my question to you is to understand how much you know. So I can plan my... Everything is dynamically programmed in my courses. Everything, all the time. My courses are geared to you. If you know this very well, then I just move on very quickly. If you don't, then I pause and I make sure that you understand that. Because again, this thing we're doing, we're bringing data science into this. That's what's happening now. So I want to make sure that we are in control of this. I'm giving you a model here. If you're a data scientist and you're just going to download the data as you were going to do this and that, you don't care about this, you just look at the data, right? But I want to ask this question so that you can, by the way, in my course, there's going to be one day, maybe a boring day, where I will tell you all of these things with math. Because it's a math version of this, with formulas and this and that. I'll do that later. On Zoom one day. Here, I want you to develop the intuition for what these things mean. So that when we go and do the boring math thing, you know where it's coming from. You have a tremendous advantage if you know where it's coming from. And then it's just math. And then the math makes sense. The math becomes life. Okay? I love my math to be alive. Dead math, no. So this thing we're discussing to make math alive. So again, I have a sense that you have a clue, maybe you don't have a clue how to do this. Maybe correlation you thought you knew, but maybe you don't really know, right? Yes? Am I right in my guess? Okay, that's okay. Nothing to worry about. It's very easy to fix. Very easy to fix. So, but let me continue, and then
One or two, like a probability.
no, I'll tell you, okay? You have to solve a system of equations. Because what's the correlation? The correlation is, think of the estimation of correlation. The correlation is, intuitively, the correlation is, and this is how you would do it as a data, I'm gonna look at you as a data scientist now because of your answer, right? So, this is how you do correlations. Say coin flips. You look at what happened in your data set. And sometimes these things, they move together. So when they move together, you see by how much they move together by multiplying their difference from the mean. And then you see when they don't move together, and then you multiply by -1, because they actually, one is going up, one is going down. And when you sum all of that, the answer is 50%. That's it. That's an equation. So that equation has an answer, and the answer is the numbers I'm going to give you here. There's a 75 probability. In other words, it's 37.5%. When you have coins which are 50% correlated and you flip them, there's a 37.5% chance they give you heads or tails. Together, 75%. These are numbers they're there. It's a simple equation. We'll see that equation later. I don't want to be bogged down by this. Okay? You believe me, but you know there's a vacuum in your understanding of correlations. We'll fill it later. Okay? Actually, this vacuum we can even fill tomorrow. But I don't care. 75% chance. In our example, in our financial example, that means there's a 75% chance that I collect money from the city and give it to the ski resort, or vice versa. So there's a 75% chance I make my $2 million commission free. 75% chance you make $2 million. That's very clear. Yes? Now, there is also a 12.5% chance that both pay me plus the commission. 12.5% chance I make $22 million. You following me? You believe that number, you just need to understand the events that we have in front of us, the probabilities I'm giving you. Or the data scientist that you hired can give them to you too. Because the data science will give me essentially something like this. Then I have to make the investment decision. Data science is not going to give you the investment decision. You will see why. There's a new element that data science will not know how to do. Maybe ChatGPT does not know how to do. I'm not sure. And this is what we are going to learn today. This is the financial consideration. Because this is the problem. There's a 12.5% chance I lose $18 million. And that's what scares me. I'm very happy with that. I'm even happier with that. This is what's giving me pause. This is why I'm not sure if this is a good deal. How do I take that into account with all of that there? How do I do that?
We can construct probability tree and estimate what would be the average money line.
If you estimate the average, you're going to see that the average is very good. It's $2 million profit. You need something new. There's a new element in the thinking that you have to develop. And this new element in the thinking was developed by a person called Harry Markowitz in 1950. He got the Nobel Prize in the 70s or something. Because he knew that by looking at how much money you can make, you will never be able to take into account this bad thing that could happen to you. So he came up with the concept of risk. It was a very primitive version of risk. And the way he did it is as follows. We're going to do what's called the investment parameters. The investment parameters are as follows. The invested amount is $20 million, which I told the city I have it. No problem. The average return is 10%. But how do I account for how bad this could be? Well, what Harry Markowitz did, and that's what we're going to do to begin, is by looking at the volatility. The volatility is the standard deviation of my cash flows. Okay, standard deviation, you've seen that? Standard deviation, yes, okay. I don't know how well you know the standard deviation. I don't care, because I'll explain it to you really well. And I start now. The standard deviation has a formula. You've seen the formula. Deviation from the mean times probability, deviation from the mean times probability, right? Is, actually this is the variance, you have to take the square root. The variance is 25. The square root of that is essentially 50, right? These numbers are approximate, 50. So I have a standard deviation, I have a volatility of 50%. What does that mean? Because now we have to make an investment decision. What does standard deviation of 50% mean?
That means that if we throw the distribution of the events.
Yep, you're giving me the mathematical answer. Yes, you're not giving me the intuitive answer.
So there's a 50% chance we're going to.
No. No. I know where you're going. The volatility being 50% means that if you expect to make $2 million, yes, there's a 66% probability you are one standard deviation from the mean above and below. 50% of your invested amount, which is 10 million. Sorry, 20 million. So it's 10 million up, 10 million down. That's what that means, right? And that, of course, describes this very well, 10 million, 10 million. But the probability is about 60%. 66, that's what statisticians tell us, right? So to take that into account, another Nobel Prize winner, Richard Sharp, came up with another measure called the Sharp ratio, which is the division between the expected amount and the volatility. He divides 10 by 50. We will see why tomorrow. Don't worry about this, or the day after. At some point, we're going to see that. Right now, I'm just telling you that another Nobel Prize winner said that you have to divide 10 by 50. And this maybe you have not seen. Maybe you have, maybe you have not. You learned it. Okay. So after you see me explain it to you, then you tell me if you learned it. Okay? Yes, I actually disagree with how Sharp derived it. We're going to derive it differently. We'll do it differently. But yes, you've seen it before. Maybe you have all seen it. Have you seen the Sharp ratio before? Okay, so you know this already. Maybe it didn't occur to you to think about this that way. Maybe. Because maybe you were given this in a very dry academic context and you didn't recognize it. It happens all the time. It's in front of you, you know it, and you didn't realize you already know the answer. And that's, by the way, why I like to teach the way I teach, like this, so that you know all the tools that you have and how you are more powerful than you think. Okay, so you've seen that. The Sharp ratio is 0.2. Is that good or bad? It's 0.2, no question about that. I divide 10 by 50, I get 0.2. Is that good or bad?
Better.
Good or bad? Do you have the intuition for a Sharp ratio of 0.2?
Yeah, it's bad. It's terrible.
Terrible, no. Terrible would be -5. That's terrible. At least it's positive, okay? 0.2. But it leaves me with, it's a bad deal. You know, if I have $20 million, this basically tells me that I can do other things. I can invest in stocks, and it's better. So I can do better things with my $10 million. That's what it means. I can find investments which are better than 0.2 Sharp ratio. So why would I invest my money there? Interesting conversation. I love the ski resort. I love the city. But my $20 million? Sorry, no. I will invest in somewhere else. Happens all the time. People don't want to invest their money. Say, right? Okay, so we have that. But we can have a better idea. That was your idea.
Yes, we can decrease the volatility.
I can decrease the volatility because what I can do, this guy is very smart, maybe you thought about that too, is why don't I do this? North America is very big. So I say, everybody go home. It's Friday. Have a drink. Let's meet again next month. I'm going to be very busy next month. I want to make phone calls to a lot of cities and ski resorts across North America. See if I have 100 cities and 100 ski resorts where I can do the same. Understand? I have a month to make 200 phone calls. Maybe explain, what are you talking about? Who are you? I don't know. But let's assume that at the end of that, I said, I got it. 100 cities, 100 ski resorts like this deal. It's a good deal. Why wouldn't they like it? Maybe it's a bad deal for me. It's a good deal for them. Let's say that I have 100 ski resorts and 100 cities. I got it. Yes? Imagine that? Okay, great. What now?
Yes, they're diversified.
I'm diversified. And if you know math, by the way, I'm giving you the names of the ski resorts. It will matter. A little after lunch, it will matter. Okay? I'll just write it there. Toronto is here. This is Blue Mountain, one of my favorite ski resorts near Toronto. I go there when I can. You may, I don't know, Whistler. You may the Winter Olympics at some point. They were done there. Very famous ski resorts. So I got it. I got 100. With 100, what happens? My investment parameters are now this is the problem. The invested amount is, how much money do I need? I need 20 million times 100. I'm going to assume the ski resorts and the cities are smart. And they force me to have money before I sign. If they are dumb and they allow me to sign without money, so great. By the way, if I could sign that agreement without money, suddenly it's a good deal. Because if I have to pay to both of them, I go bankrupt. Big deal, I don't care. I have a 12.5% chance of going bankrupt. Is there a problem? I have a 87.5% chance that I make money, right? So if they allowed me, I didn't mention that. You see how many things can now unearth from. If they had allowed me to sign that deal without money, I signed the deal. I go bankrupt, big deal. I do this through a limited liability corporation. I said, no problem. Are you understanding this? This is how the finance world works. But we're not doing default yet, okay? So that's why I do that. But now my problem is that the invested amount is $2 billion. That's, I don't know, billion is 1,000 millions. I don't know how you say billion in Georgian. In English, billion means 100 times 20 million. 2 billion. It's too much money for. I don't have it. Do you have it? Do you have it? No? Do you have it? No? Well, it's a lot of money. 20 million is a lot of money too, by the way. But 2 billion is not a huge amount of money, right? But guess what? The average return is the same. But the volatility drops to 5%. Because all of these cash flows are independent of each other, right? Sometimes when I say that, people say, no, what if there's global warming? global warming. I'm sorry for global warming. I'm sorry for the weather, but it does not affect my cash flows. It just means that I'll be giving more money to ski resorts and less money to cities. But each swap will still be independent of each other because they're very far away. Unless I have a very strange meteorological effect that says, now all the snow is going to cities and no snow is going to mountains. Then I have a problem. But I don't know that. I don't know that that's even possible. Right? Understand? Great. So I have, now what's my Sharpe ratio now? Damn, this is fantastic Sharpe ratio. It's a Sharpe ratio of 2. It's a great Sharpe ratio. 2? Poof. Oh yeah. If I had $2 billion, I don't. But if I did, oh, I put it there for sure. Yes? So my problem is now, so this is great. You know, everything is coming into place. My problem is now I don't have $2 billion. So this is a great idea, but now what do I do?
Like finance.
Yeah, well, that's where the word finance comes from, right? So how do I mean, I love this deal, right? I absolutely love this deal. $2 billion. How do I take advantage of this?
Issue shares.
I can issue shares, you're right. I can issue shares, I can create a company and issue shares. I could. It's going to be, when you do that, so the answer is yes, that's a good way to do it. The problem is that when you issue shares, here I have no assets. It's going to be difficult to issue shares. And there's some technique, but okay, that's a good idea. I issue shares.
What if we ask for down payment to every like ski resort and
Okay,
emergency funds?
okay, so we could do that, but if I am a city or a ski resort and I'm smart, say, wait, you're asking me for a down payment? Where's your down payment? Oh, I see, you don't have the money. Oh, deal's off. Right? If they're smart.
Yes.
Of course, if the other counterparty is not smart, take advantage of them. That's how finance works, right? Another possibility, which is the one I want to entertain, is essentially yours, but it's a bit more targeted because it's going to be very, very difficult to sell this company. Is let me approach my friends. I call Elon Musk. Have you heard of Elon Musk? I call Elon Musk. Hey, you have some money? Elon says, I give you, how much you need? I give you 500 million. Okay, I got 500 million. Then I call my other friend, Bill Gates. I said, oh, I'll give you another 500 million. Okay, I got $1 billion now. Okay. I call the Cartoon Foundation. I said, oh, this is a good investment. Look. Oh, I'll give you 500 million. Okay, let's say that I have friends who can give me the money. How does that work?
Wouldn't they ask for a high return as well? Like,
Well, that's what I will discuss at 3. We're going to take a break now. Because this is where things now get really, really interesting. We're going to have to start. So this is just ideas. We had the idea. There's the conception, right? Now, this is ready to be born. So at 3, we will give birth to the financial product that will help us do that. We have to create a legal entity. We actually have to create something. That's why I call it birth. Something will be created. It could be your company. I'm actually going to do a fund, which is essentially the same. A fund is a company without employees. A company, but to do my fund, I have to do other things. I have to create a management company. And I have to hire a bank. And I have to hire an administrator and an accountant. And then suddenly the whole financial system will be created just because of this deal. We'll see the role of the bank, the role of the accountants, the role of the managers, and we're going to see who makes money. And it all because of some data science exercise that tells me that this deal is a good deal. Yeah?
Very interesting.
Thank you. It'll get better. It'll get better because, and I advise you, and that's why it would be good if someone else is here, because what I need to do now is to make this happen. I am going to create a company for this. Me is no longer enough. I need a company. And I need to hire people. So I'm going to hire all of you to do this. You're going to have a role to play. And a salary. We're going to negotiate salaries today too.
We lost our jobs, right?
Well, you can quit your job. This is better, okay? But we'll do that at 3 when someone else is here. It's a woman, right? So I'll make sure that I explain to her what we're doing so she knows. So maybe I spend 5 minutes explaining this in a summarized way. But now it gets interesting because we're going to create something. And that's the beginning of everything. Okay? And by the way, when we do that, then you will see suddenly many things matter. Many things related to your data science analysis. And so the whole concept of finance and information management comes alive. And it will help us create a whole financial system. And that's why, in my opinion, this is the example of everything. The whole program, the whole master's program, can be brought down to this particular deal. Okay? Okay, go have lunch. I'll see you at 3. So this morning, to be consistent with that, what we did is we started with I wanted to describe what I call the financial products life cycle. I want you to understand why financial products exist. Because once you understand why they exist, they become easier to understand. And so I wanted to focus on the idea, on the conception, on the birth, which we're about to get into, the growth, and the death, the 4 parts of the life cycle. And I started with a very simple example of a deal which was going to happen at the City of Montreal but didn't happen. And that is a deal that had to do with the cleaning of the snow in the city. It's a very expensive activity that Canadian cities do. North American cities do that too. They outsource that to companies who give a contract on a monthly basis. So the city has the difficult decision to tell them which months they want cleaning and which ones they don't. Cleaning out of the season is very expensive, but of course every month carries a cost. So a lawyer, someone had the idea that the ski resorts have the opposite problem. They want as much snow as possible, as late in the season as possible. So he conceived a swap between a ski resort and the city, where the city will pay money if there is no snow, and the ski resort will pay money to the city if there is snow. It was a beautiful idea, but it didn't work because they could not agree on where to measure the snow. So at this point, history ends and fiction starts, and I decided to step into these negotiations and offer 2 types of deals. One to the ski resort, where we allow them to measure the snow wherever they want, and another one with the city, that they can measure the snow wherever they want. I step in the middle, I give them what they want, and I take the spread risk. Spread risk is if most of the time I expect these cash flows to go the same way, but when they don't, well, it could cost me money, it could make me money. And I do that for a commission of 10%. We hypothesized about that, and we saw that the portfolio cash flows could be modeled, and this is just a mathematical modeling. He proposed a better approach, which is using data science, which essentially yields the same result, but it would be more accurate. And in this case, But this is easier to understand. And in this case, what we saw is that under these assumptions, there's a 75% probability that I simply take money from one, give it to the other, and collect my happy 10%. There's an even happier scenario, 12.5% chance that I collect money from both, plus my commission, so that's 22 million. But there's a very, very unhappy scenario where I have to pay both. And this could happen with a probability of 12.5%. We analyze this investment with a very basic investment parameter approach where the average return is 10%, and the standard deviation, which is defined as the statistically from the cash flows, gives me a volatility of 50% of the cash flows. We discussed that this is not a very convenient investment. If I had $20 million, there is easier ways to make this type of investment outcome. This is what's called, we summarize this with the Sharpe ratio, which is the division between the return and the volatility, 20%. But then this thing, which is a bad deal, can be turned into a good deal with an idea which actually originated from, don't tell me. Gega.
Giga, yeah. You're correct, actually.
Yeah?
Giga.
Gega. Okay. Which is the creation of a diversified fund. So I'm going to do this deal in 100 cities and ski resorts across North America. I choose 100 for simplicity. This would be my counterparties, these ski resorts that are right here. And the investment parameters are very attractive, except now I need 20 million times 100, which is $2 billion. That's a lot of money. I don't have it. So, but the investment return is 10% on average, which is great. The standard deviation, the volatility is 5%. We didn't go through that in detail, but you're probably all aware that this is the reason. Well, the reason for this is that these 100 uncorrelated swaps, so the standard deviation will, on a relative basis, will decrease like the square root of the number of deals. I have 100 deals, so square root of 100 is 10. Is that clear to everybody? This is basic probability. If I flip a coin and it has a standard deviation of 1, if I flip 10 coins, it will not have a standard deviation of 10. It will have a standard deviation of 100 root of a square root of 10. You've seen that? Yes? Central limit theorem. Sounds familiar? We're going to see all of that here in great detail, okay? We're going to get into but I am counting on at least your intuition that these are the numbers that work. So this gives me a Sharpe ratio of 2, which is great. This would be a great way to invest $2 billion if I had them. The thing is that I don't. I actually don't even have 20 million, but at least with 20 million I have hopes that I can come up with that money. 2 billion is just too much. So we left it here. This is what's called the conception. This is the idea. This is how things happen. But then, how do you do these things? So he proposed the creation of a company, which is very similar to what I'm doing. In fact, the legal structure is quite similar. But the actual term I'm going to use is I'm going to create a fund. A fund is actually a company, a limited liability company. But the legal structure is a bit different. It does not have shares, it has shareholders. It does not have employees. It has a management company that it contracts the research. So I want to explain to you how funds work. Now, these are not investment funds. Most of the things that happen in life come from an investment fund. If you have to build an airport, they build a fund to build the airport. Every time there is a major infrastructure project done, a fund is created. So this thing I'm talking about is not for snow swaps, it's for everything. When this university was built, I suspect the Carter Foundation created a fund for the university. And then everything that the university needs, buying that table, that window, came from the fund. And the funds are typically always the same. It's a legal structure, sits in the middle. The legal structure will be domiciled somewhere, some country. If you're doing this university, the fund will be in Georgia. For this fund that we're doing here, very likely I will do this fund in the Cayman Islands. Have you heard of the Cayman Islands? Yes? Yes. Okay, I'll tell you why I will do this in the Cayman Islands later. Let me go into how this fund would be structured. So funds have investors. Sometimes they are single investor fund, like for example, this university was funded, I understand, by the Cartu Foundation. I don't know if it was in its totality or not. Maybe some money came from the government. So let me assume some money came from the government and some came from the Cartu Foundation, and let's say that you are very wealthy because you made so much money after you took this course that you donated some money to the university. Then this fund will have investors. In this case, 3, not 4, government, Cartu Foundation, and you. In our case, in our fund, we discussed 4 possible investors. Elon Musk, who's a friend of mine, Bill Gates, who's a friend of mine, he was going to put some money, the Cartu Foundation was going to put some money, and I forgot who, someone else was going to put some money. So I have 4 investors and they put money. Does not have to be the same, could be different. Very similar approach to the way you create companies, but now this is a fund. And the fund is a little bit different from a company. The fund has a management company. The fund doesn't really do anything. So let's get into the guts of this. This is a fund to do what? This fund will collect $2 billion from the investors. So $2 billion going to the fund. The fund has $2 billion. Now the fund is going to be entering into swap agreements, right? With cities and ski resorts. Okay, great. How do those swaps work? Let me get into that. How do these contracts work? The contract is a piece of paper, and at the end of it, it contains signatories. Someone signs for the city of Montreal, the mayor, the treasurer, the controller, someone, an official from the city with signing authority will sign. Who signs on the other side? Who is responsible for paying the city? Who will be signing on that contract?
Other side of the swap?
You
mean other side of the swap?
Yes, in the other side of the swap.
Then that company that controls the resort.
No. Remember, when I do this with the city, the counterparty is me. The fund, yes. So the fund will be signing. And in the swap with the ski resort, it will be the ski resort, chief financial officer, and then the fund again. But now from the fund, who signs? If this was a company, the chief financial officer of the company would sign, or the CEO of the company would sign. But this is a fund, like the fund who created this university. That's not the Cartu Foundation. That's not the finance minister of Georgia. Who would that be?
Fund manager?
Okay, so the fund manager does not really exist because the fund is a legal structure which is very, very thin. It has no employees, and therefore it has no fund manager. What the fund has is what's called a management company. So this is something I need you to understand this very, very well. Very, very well. This is something that it's typically not understood. And once you understand this, you understand how the asset management or the investment sector works. So let me go to, let me leave this example as I go to another example. Have you heard of a company called BlackRock? BlackRock, sounds familiar? Is perhaps the largest investment company in the world? No, doesn't sound familiar. No, very big company. Can you check how big they are? Are you fast with ChatGPT? If I ask questions, can you answer quickly? Yes, like very quickly, within 2 seconds. Yes, no. Very big, very, very big. All right. So they have funds. They manage funds, many, many, many funds. And the funds are always the same. They are very lean structures. They just contain money from investors. There is a management company that manages the fund. So if I'm going to do this snow fund in Canada, I will have to create a company of my own. And this fund will hire my company to manage the fund. Yes? So let me stay there. This is very important. Let's say that I am doing this and I got my friends to give me $2 billion, so I'm ready to do that. And now I'm going to create a management company to do the fund. And I need help. How can I do this all on my own? So I'm going to hire people. I'm going to hire people. I need a lawyer. Who wants to be my lawyer? I'm hiring. I'm paying very well. Who wants to be my lawyer? If you're not ready to raise your hand when someone offers you a job, I promise you, you will have a not very good life. So, who wants to be my lawyer?
We don't want to be lawyers.
Eh?
We don't want to be lawyers.
That's the first job offer I'm giving. So who wants to be my lawyer?
Oh, I can work for yours.
Thank you, Annie. Annie?
Yeah.
You're my lawyer. Thank you. Thank you. These guys, I don't. They're not going to succeed. Okay, you will succeed. Okay, good. So I have a lawyer. That's great because that's my most important thing, right? I'm just doing contracts all day long, right? Without a lawyer, how can this fund work? So you're going to get an expert on dealing with cities and ski resorts, right? Good. So you're my lawyer. I'm going to ask you a question, but you're not going to answer now, which is how much shall I pay you? Don't answer. But that's your question. So yeah, I'll be your lawyer, but, right? Okay. What else do I need? I need a financial officer. I need a chief financial officer, CFO. Who wants to be my CFO? These guys. You're my CFO. Nikita. Nikita CFO. You're my CFO. What do you do? What's your job?
I think my job would be to control it.
You're the one who's going to be calculating the money. As you will see, we have to count a lot of money. Money coming in, money coming out, money that may come in, money that may come out, right? Very important job. You're the chief financial officer, Nikita. Yeah? Okay. How much shall I pay you? Don't answer now. Yes? Great. Okay, what else do I need? That's it. You guys are unemployed. That's not true. I need more. What do I need? What else do I need?
CEO.
No, I'm the CEO. Sorry. That job is not. I need a salesperson. I need a salesperson. Someone has to go out there and talk to the investors, right? And either get me investors, and as you will see, we'll have to get more investors. We may have to apologize to them. I need someone that manages the investors, say a salesperson. Sales, marketing, customer relationships, same thing. Who wants to be that? Thank you, thank you, thank you. Mariam. Yes. Thank you, Mariam. You are the salesperson. You're the one in touch with those people. Great. All right. What else do I need? Am I running out of positions? That's it? Every fund needs a very important person. Legally required.
Risk officer.
Hmm?
Risk officer.
Okay, that's important there. So there's two jobs left. I need a chief risk officer, and then I need a chief investment officer. That's it. Yep, you have to pick. Chief risk officer, chief investment officer. The chief investment officer is required. That's the person who will be the one doing the deals. Every time we do a deal, by law, we need to have someone who takes responsibility. This is the equivalent of someone with a driver's license. You know, if we all go on a tour and we get a car, whoever is driving the car needs to have a driver's license. It's not if you're a good driver. It doesn't matter if you're a good driver. You have to have a driver's license. Without a driver's license, you cannot drive the car, right? Driving is a regulated industry, and only licensed drivers can drive. When you invest, it's the same thing. Only licensed portfolio managers can invest. It will be illegal to have someone managing the money who's not licensed for that. We'll get into the licensing a little bit later, okay? So I need that, and then I need a chief risk officer. And there's no licensing requirement there. It is not even a legal requirement for a fund. It's a legal requirement for a bank, but I'm not doing a bank. I'm doing a fund. In a bank, yes, Tbilisi Bank has a chief risk officer required by law. A fund, no. But I need to have a chief investment officer. So I need a chief investment officer and a chief risk officer. Are you guys ready to work, or you don't want to work ever in your life?
I'd love to work.
What?
I'd like to be investment officer.
Yeah, okay, so you're the chief risk officer if you want. I mean, you have no options left. You were waiting to see what happens at the end. All right, so, and the question that I want now every one of you to have in your mind is, how much money can I make? All right?
I think
he has to decide how much money we should oversee.
Well, okay, so this is, we're going to talk about that. This is something that I also need you to understand. At some point, you're going to be applying for a job and you're going to be, hopefully, you want to make some money? Anybody wants to make money? No, I'm asking. Some people don't want to make money. Do you want to make money?
Of course.
Yes? No. He's not sure. You're not sure.
Yes, I mean.
Zura,
Yes.
you're not sure if you're going to make money. You know,
So I
you want to make money. Oh, so this is a very important question. I also want you to understand that today. By the way, I have a call at 4. At 4, I have to take a break. I'll give you something to do at 4, okay? But I have to take a call. I have to. So, you all want to make money. Let's talk about that. It's a little bit early because I have to tell you some other things. But so that you start getting into we're talking about money now. Now we're talking about money, not funds, not the financial sector, no, money. The one that goes into your pocket, money, okay, money. Of all of the 5 employees I have here, who do you think is going to make the most amount of money? We haven't started the negotiations. Maybe that person is a very bad negotiator and I managed to get him or her very cheap, maybe. But who is the one that should make the most amount of money?
Are you included as CEO?
Okay, let's talk about the CEO a little bit later. I'm talking about the 5 of you now.
I think me.
You think you? Everybody thinks they should be the ones making the most amount of money. Sorry, that's just a joke. Who do you think should make the most amount of money?
I'm not sure.
Who do you think?
Well, I also think him because he's the only one that's technically required for the job.
Mm-hmm. Mm-hmm.
Under like engine, without me, the company.
The company will not work. You're absolutely right on that. The company will not work.
I think we.
Do you think you? You're the chief financial officer, right? Okay. It's actually her. Mariam. Salespeople are typically the ones who make the most money. Because without her, you have no money to manage. Sorry.
Okay.
And by the way, this is not something that I'm doing just like that. I want you to be very well aware of that. Especially in programs like these ones, which are very technical and people really take immense amount of pleasure in writing Python code to do wonderful things. It's great. It's very good. But you go get a job, the people who make money are the salespeople. And this is not something that I'm saying gratuitously, because I have been saying for a long time to all of my students that they should always consider a career in sales. And it's not because of the money, it's because of where the industry is going. The industry is going into a very sophisticated space, so sophisticated that traditional salespeople don't work. You need people who understand the products very, very well, as we are about to see. Okay? Imagine you're selling self-driving cars. The traditional salesperson doesn't work. You need someone who understands self-driving cars, because the question you get asked by the customers, traditional salespeople don't know how to answer. Is it safe? Well, you can learn the answer written in a manual, but you need to understand a lot about AI if you want to answer those questions, right? So I want everybody, all of you, you're very young, I want you to be very aware that especially the sales profession, all professions, but especially the sales profession, are very much moving towards you, towards what you are doing here in this program. Okay? We're not, okay? So, well, maybe you are a very bad negotiator and I get you for nothing. Maybe, I don't know. I'm not going to just give you money for free. If you don't negotiate, I don't give it to you. But you should be the person that will probably make the most amount of money, followed by you. So you'll be perhaps the second one. Perhaps. Right? And then the rest, we'll talk. But now, where's that money coming from? If I'm going to pay you a salary, that's another advice I give all my students. When you're negotiating a salary, you need to understand where that money is coming from. Where's that money coming from?
From our customers who are
Is it coming from the $20 billion? Is it coming from the Carter Foundation? Is it coming from Elon Musk is writing you a check? How does that work?
It's coming from the city and the
From?
cities and the ski resorts.
From the ski resorts? No,
Yes, that's
no,
the
it's
million
not coming
dollar.
from the ski resorts. Thank you for that answer. Thank you very much for that answer. I love answers which are incorrect because they help me tell a story, right? No, it does not come from the ski resort. Where does it come from? See, the ski resort only gives me money after the snow. In fact, maybe I pay money to the ski resort.
Oh, they pay after, okay.
But then you can say, you can argue with me and say, wait, no, they give you 10%, which is where the money really is coming from, right? I say, yes, you're right, they give me the 10%, but it's only after the fact, because when I start my company, I have no money, right? So another wrong answer. You guys don't talk very much, you have to talk more, okay? And that implies you have to make more mistakes. If you always give me the right answer, that's wrong. That means you don't give me enough answers. So you have to be right at most 50% of the time. If you're right more than 50% of the time, that means you're not participating enough. Understand? All right. So another wrong answer would be comes from the investors, which is technically wrong. You could also, another possible wrong answer would be it comes from the fund. But that's not true. I cannot, you're in sales, right? You have to explain to Elon Musk where his money went, right? You don't want to say, well, some of that came to me. You can't say that, right? It'd be very bad. You cannot say, so no, it does not come from the fund or from the investors. These are two wrong answers. More wrong answers. I need more wrong answers.
The snow?
Yes, from the snow. Oh, thank you. No, it also does not come from the snow. Where does that money come from? Let me ask you another question. Don't answer.
Oh, maybe.
Hold on. Don't answer. No. Let me ask you another question related to that. I'm done with that. Who's hiring you?
The management company.
The management company. Which legal entity? When you're hired by, okay, have you seen employment contracts? Yes? You are doing an internship, you probably signed the contract at some point, right? Did you read it? Oh, read it. No. You read those contracts that you sign, not because they're going to screw you. No, they already screw you. There's no problem. No, read them so you learn. You need to learn about contracts. When you get hired, read those contracts. And yes, maybe see if there's something bad. But more than anything, learn. Who hired you? Or who's hiring you in your internship?
City Hall. Kutaisi City Hall. City Hall.
City Hall.
Yes.
Okay, City Hall. Let me challenge that. Okay, for me, maybe I'm wrong. Okay, but City Hall for me is a hall, building, right? I don't think that's what you meant. If you go to the contract, I can almost guarantee you that the person that is signing on the other side, it does not say City Hall there. What do you think it says?
This is a place from where city is governed.
Okay, so the a very important remark is a contract is between two legal entities always. One could be you, a person is a legal entity, and the other on the other side of the contract is also a legal entity. So very likely in your case, the legal entity is the city as a corporation. That's my guess.
The government has organization.
Yes, the governments have agencies and they will have a legal structure. They will have a legal existence. So that's my guess. Could be the city as the legal entity, right? Like the university is a legal entity. BlackRock is a legal entity. Bank of Tbilisi is a legal entity, right? A person cannot really hire you. I'm being very picky, but I want you to understand these things. It's so important. If you understand this, you will make money. You don't understand this, you will probably not make money. Okay? So now I'm done with wrong answers. I want the right answer now. Who will be hiring you? I have 1, 2, 3, 4, 5, 6 legal entities there. Which is the legal entity that will hire you?
The management company.
The management company, right? It couldn't be any other. Well, the fund. No, the fund cannot hire you. We already went through that. It's not like a company. A fund is a company with our employees. They cannot hire you. It will be very bad. It will give you a very hard time. If you have to, if the fund hires you and the fund has expenses, you have to bring all these expenses to Elon Musk. Good luck explaining and negotiating the salary. You want to negotiate with Elon Musk? No way. No, you don't want that, right? You don't want that. You're all employees of the management company. You all work for the management company. Sure, it's my company. I'm the CEO. So maybe I'm the one signing, but I'm signing on behalf of that legal entity. I may have other legal entities who are not going to hire you because you don't work for them, you work for this one. So you work for the management company. All right, so if the management company is going to be the one hiring you, where's the management company? Where's the money from the management company to hire you? How can they hire you?
My guess is that we got the 2 billion investment, right? Maybe from interest on that 2 billion investment.
Okay. You're almost right. You said interest. No, interest is something. Interest is related to a loan, a bond, right? Interest. But you're close. You're very, very close. You're very, very close. I'll correct your statement in a few minutes. I'm not interested in that right now. The management company, as it's here, what's happening? Oh my goodness, what's happening here? Something is very wrong here. So the management company, damn it, this is bad. Why did that happen? Okay, I'll have to fix it during my break for the call. I'll have to fix this. So the management company is going to be the one hiring you. But the management company has no money. I have to figure out how the management company makes money. Why do I do this? I'm the CEO. Am I doing this for free? Just for fun? I need to make money too. By the way, now to the questions you asked earlier, in this situation, I will probably not make a lot of money. You will for sure make more money than me from a salary perspective. But I'm also the shareholder of the management company. I own it. And that's where I'll probably make most of my money. You will see, right? But one thing is suddenly needs to be addressed, which is how much money is the management company making? We don't know that, right? So there is a very important commercial deal that we have not specified. We understood there's no swap. City pays the fund, fund pays the city, blah, blah, right? Investors make 10%, we understood that. But why would I do this? Seems that everybody's making money except me. No? Why would I do this? There's something very important here. And not only is important in this example, the financial sector has essentially 5 branches or 5 subsectors. Banking, you know banks? You know how banks work? Well, we're going to see how banks work because they're going to show up. They haven't showed up yet. Insurance companies. Insurance is part of the financial sector. You know insurance companies, yes? Investment sector, asset management sector. This is it. There's trillions and trillions of dollars around the world which define businesses just like this one. So this thing we're talking about, we're talking about trillions of dollars of business. Trillions. And then we have payment systems, credit cards, Bitcoin, payment systems, and financial services, consultants, tax advisors. These are the 5 sectors of the finance, right? We're talking about this one, which is the investment sector. I started with that because the investment sector feeds all the others. As you're going to see, banks will service the investment sector. Insurance, well, we'll see. Okay? All right. So we need to figure out how the management company makes money. We haven't talked about that. Without that, how can we know how much you will be paid? So I need to talk about that. But before I do that, let me talk about the other providers to the financial banks. Do we need a bank? Yes or no?
Oh, yes, probably.
Oh, yeah. Where am I going to put the $2 billion? In cash? In my house? I need a bank. right? Typically, banks is where you hold your money, but you have another player, which is the broker. In this case, I will not need a broker. It's a very particular type of fund. I'm not going to need a broker, but we will talk about brokers in other examples in the future. So typically, I need a broker. That's a financial intermediary, typically a bank. Administrator, this is an accounting firm that is going to essentially calculate the money. These are going to be your counterparty. You'll talk to them every day. And auditors. Auditors are going to be also accounting firms, but they have a more legal function. So they'll probably talk to my lawyer, Annie. You're the lawyer, right? Annie, on a daily basis. And you can see now we have financial services, banks, asset management. We're missing insurance, but we have the financial sector here, right? All because the city of Montreal has difficulty paying for the cleaning of the snow. The whole financial sector comes up because of that. It's very important that this thing is conflict-free. I'll talk about this later, okay? And now a fund has directors. I'm not talking about that. It's just a technical thing, which are the closest thing that we can have to an employee, but I'll talk about it some other time. Hold on. I need to have something very important to say here. Okay, so I have a call at 4. I was planning to ask you to do something during that break, but not. I will just ask you to take a break, and then we come back after my call. Okay? So I didn't get far enough into what I wanted to tell you. There's one assignment I want you to do, but I prefer that you do it when I'm finished. Yeah, okay. Now, let me talk about something related to this, but I don't know if it's too early to mention. It's what's called the master feeder structure. No, I'm not talking about that right now. Let me jump over that, okay? Let me talk about this. Let me talk about how the management company makes money. And say 120 fees. This is what I have. I'm the CEO, so I decide how much I want to charge the fund. By the way, this is not my decision. The fund may say, oh, here's too much money and they don't want to pay me, and then there's no deal. So this is also part of a negotiation. So let's say that I negotiate with the fund that they pay me in 2 ways. They will pay me 1% of the money they have, and they pay me 20% of the gains I make for the fund. If I make no money for the fund, I'm stuck with the 1%. If I make them a lot of money, they will pay me the 1% of the money invested, plus 20% of the gains I give them. This is very, very typical. If any one of you has invested, have you invested in a mutual fund, for example? No? I guess not, no. You invest in a mutual fund, mutual funds have no performance fee. They don't charge you for the net gains. They charge you for the percentage of the assets. Typically a 0.5%, for example. This is an expensive structure because I'm doing something very specialized. If you do something very specialized, you can charge more. I picked this also because it's very easy to do calculations with 1 and 20. Okay, so this is how it works. The proposition I have for my investors is that I'm going to charge them 1% of the money invested and 20% of the money made. Let's see how that works. They invest $2 billion, right? Okay, I say 0 because I invest 0. The manager or the management company invests 0. Let's say that your portfolio is very good. You're a very good investment officer, and you make 10% as we saw we can make. On average, you will make 10%, right? So you make them $200 million gains. I'm going to charge, this is the financial officer, so Nikita should be doing these calculations, right? How much do we charge them for this? So the 1% gain is $20 million of the $2 billion that the investors are investing, right? So 20 million goes from the investors to the management company. That's my income. The management company. But then, what's the net gains? Again, these are the calculations that you do. It's $180 million. 200 minus 20, that's net gains, 180. I charge 20% of that. So I'm going to charge $36 million on top of the 20. Right? So my company makes $56 million per year. By the way, the investors will make 144 net of fees. They don't make 10% anymore. Some of that goes to my company, so they make 7.2%. It's still good. But this is how things work. My company will make 56, the investor will make 144. Let me ask you a question. Which column do you like more? The investor? Okay, so you like the manager column. It took you less than a second to decide that you like the manager column. Which one do you like more?
I like the manager column because it's about our salaries maybe.
Okay, which one do you like more?
Manager.
Manager, Annie?
Where did the 7.2% come from?
Oh, if you invest $2 billion and I give you 144 million, that's 7.2. So which column do you like more?
The manager.
The manager? Okay, everybody likes the manager. And yes, it's right, it's correct. Everybody likes the manager. Let me make a comment. You all like this column. Well, you're all here because of that column. So that's good. You're all here because you're going to be part of that business. That's a business. That column is a business. By the way, I could give you another column, which is how does the bank make money? The bank makes money too. And I could give you another column, which is how does the service providers, the financial services people make money, the administrator, the auditor. That's there also. Yes, so yes, these another columns. But then this column is very important because this is the source of the money. If some of you was very, very rich, you will say, no, I don't want those, I want this one. Very rich people will want this one. Think about it. This is little money for a lot of work for a very rich people. In fact, that's why Elon Musk hires people to do that for him, and he doesn't. He just makes money making Teslas and space something and this and that. That's how he makes his money. He likes other businesses, not the management business. If you run a very successful food company, you want your food company column, not the financial services column. And that's how the economy works. So financial services assist other businesses, like in this case is cleaning snow. If you ask the city of Montreal, what would you rather be? You say, no, I just want to run the city and make sure there's parking lots and roads for everybody. That's their business. And in doing that, they will hire financial services to do that for them. But in this business, in this program, you're here for that column. So I'm glad that you all like that column because you came here for that. And of that column, what's your favorite part? The 56 million, when you invested nothing. That's the value of an idea.
So what?
That's the value of the idea. That's my idea,
Value.
right? But you see, to do this idea, I had to do a lot of things. I had to hire people, I had to set up a company, and then I make a lot of money. So I think we're now ready to understand what your salary should be. So I need to take this call now. Let's take a half an hour break. After half an hour, I come back, and then I'm going to start to talk to each and every one of you. That's the next point, is how much money you will make. And I want to help you negotiate. I want to help you understand how you should be paid as a function of where your job goes into what row. So now you think rows. Think of your job, you remember your job, and then think rows, and then we come back and talk about how much money you make. Okay? And then that will get us on a very good course to end the day today, which as you can see is where everything is unfolding. The whole financial services, the whole financial sector is unfolding in front of us just because the city of Montreal had a problem cleaning the cities of snow. And then everything from FEM will be to service what we learned here today. That's the summary of what we're doing today. Okay? All right, I see you in, give me half an hour, okay? Go have a coffee or something. Okay, so we'll make it easy, very easy. We're not going to talk about numbers yet. I want you to identify for me which column you're related to. So for sure, have enough money to make everybody very happy. But for that, it's very important that your salary is aligned with the business. And that's all we want to do for now. Okay, the actual number, of course, we don't know. But so in your case, what's your row of revenue?
I'm on the manager's side.
You are, no, row, not column.
Oh.
Row. So I have two sources of revenue. I have this one and I have this one. Right? So you're on that one. Right? You are on that one. And you, Keka,
Yeah.
are on this one.
Yes, and I'm responsible for the second row.
So you're responsible for what?
The second row.
Second row. This one.
Yes.
Yeah, except, but if that makes me nothing. That makes me 36 million, right?
Yes.
So those two are kind of easy. I will compensate you with something related to that row and you do something related to that row. In fact, in your case, I would probably be happy to have a variable compensation. In your case, I will give you a percentage of the management fee. In your case, I'll give a percentage of the performance fee. Right? Okay, so what percentage?
Maybe 10%.
10%, there you go, 10%, 10%. And in your case,
I would take 15.
I'll give you 10%. Take it, 10%.
I'll take it.
That makes sense. I mean, 10% is perhaps a very big number, but that's the way you think, right? So, your case, you are my lawyer?
I am.
You are my lawyer. Okay, great. So how much shall I pay you?
Well, from here, I guess I'm definitely part of the management fee, and I guess I also work on the separate cases, so am I part of the performance fee?
You're a good negotiator. You're a good negotiator.
From both of them. So
Okay.
From total gains, which is 56 million, the department of the law, not particularly me, will get some percentage, which I guess, well, 10 is a very good all-around number.
Okay, why not ask for 10? In practice, and this is what you will see.
Maybe it's
So
the-
let's now go. Let me go back to them, and let me. Then I come back. Do you see why I do that? Then I go back to them and say, okay, your variable 10 and 10, no problem. How about your fixed?
I will take $1 million.
Okay, so if I pay you $1 million fixed, I'm not going to pay you 10% of the revenue.
Yeah, I would like maybe 1 billion and 3%.
Okay, so okay, I see where you're going, and I will probably not do that. To you, I'm going to give you the lowest fixed I can. The lowest fixed I can.
That's fair.
What's minimum wage?
In Georgia?
Yes, it's in Georgia.
It's
What's for that?
10, like a little less than $10.
Okay, so let's say that I give you minimum wage. I'm exaggerating a little bit. Maybe to you I give minimum wage, but then I give you 10% of the performance fee, which is 2% of the net gains. People who do the kind of things you do, they typically get paid like that. The people, we stay away from big. I mean, $1 million is a lot of money. It's 5% of my fixed revenue, right? And that means I could have to pay you that money whether you do any work or not. So your job, you typically get paid very little for that, and then a big fee. How about you?
As you mentioned, salesperson makes
That's the variable. How about the fixed?
2 billion.
It'll be the same as him. Both of you, I will pay you as little fixed as I can, close to zero. I'll pay you zero if it was legal, but it's illegal. So I'll pay you very little, but then you have a very healthy variable. So maybe I'll pay you $100,000 a year. Not $1 million, no, 100,000 maybe 50,000 if I can. But then I give you 10% of the variable. And you will see how this actually makes a difference when we change the business a little bit. Now, how about you? Given what I just talked to them,
Because like unlike them, I think mine is mostly fixed.
so you, the lawyers, you will make a very big fixed and no variable typically, or very little variable. Then maybe I give you a bonus based on the company's performance. So you can ask for $1 million a year, but then I'll give you $1 million.
But that's pretty much
And in fact, to you, to the lawyer, I really like to pay lawyers independent of how profitable the business is. Because imagine I pay you like I pay him, right? Now suddenly, you may be aligned with taking risks to increase the performance. I don't want lawyers to be aligned to taking risks. I'll probably pay you $1 million, and I don't care if we make a lot of money. That's not our business. So you may be the highest paid fixed.
well, depending on the success of the company.
Okay, but if you understand the difference, I said earlier that you will be the highest paid, and you may be the highest paid in the arrangement we have now. He will be the highest paid because he gets 10% of that, so that he's going to be ahead of you. But typically, right? But that's on a floating basis, on a variable. On a fixed, you will probably be the highest paid, right? Understand? And then that's why lawyers, they make a lot of money, but they don't make like a huge amount of money. They can make a huge amount of money, right? Okay, so we got it. How about you? You're the chief risk officer. Yes. But so how shall I pay you?
Maybe I will have some fixed salary since.
Yes. To you, I will probably just pay fixed like her. In fact, the chief risk officer and the lawyer have very similar job descriptions. You're all paid to take us away from risks. So to pay you a compensation which is variable, I'm encouraged. A variable is an option. So I encourage you to take risks, right? So you will typically be paid fixed, maybe a lot of money. Maybe you can ask for $1 million and I'll give it to you. But you will pay fixed.
So maybe it will not depend. It's not depend on sales. It's a fixed amount of salary.
Yes, I mean, you can ask for $1 million, and maybe I'll pay you $1 million, $1 million. And how about you, chief financial officer?
Well, based what you said, others, I would say at least 200,000 fixed and plus some about 10%.
10% of what?
Total gains.
Of the whole profit.
Like a bonus or
Okay, so for you, I will probably pay you fixed like them. So this is so that you understand. You, and you, I'll probably just pay $1 million. Maybe you pay maybe a little bit more. Lawyers are expensive, right? And it will be very hard for me or for you to convince me to pay you floating. I'll pay you fixed, right? Because in your case, I mean, okay, if you have no mistakes, I'll give you a bonus. I mean, I cannot do that, right? Your job is to have no mistakes. But in your case, I'll pay you very little fixed and a lot of floating. But if I do that, my company financials are pretty good, right? And I will make a lot of money. Now I will be the one who makes the most amount of money. Because I have to pay $3 million here, to the three of you. And I have to pay $2 million and $3.6 million. So about less than $10 million of expenses for the company. And you will be happy, but it was my idea, my company. So I'll make more than $40 million per year. Yes?
That's great. It's amazing.
It's great. But at some point, maybe you, after a year or two, say, you already know all the clients. Maybe the two of you go out and create a new company to compete with me, right? So what I will do, since I know that you could, you know all the legal contract, you know all the juice of my money-making business, right? Maybe what I will do is not pay you just $1 million. Maybe what I'll do is I'll give you something else. I'll say, well, in addition to your fixed, if you're still in the company for in 5 years, I'll give you some shares in the company. And then lawyers are typically not very risk-taking. They don't like to say, oh, that's great, and you stay. You will never leave, right? So maybe that's how I will retain you. Maybe I'll do something similar with you because you're going to know a lot about this company. And this is what the investment management sector looks like. At some point, there are secrets in the company which are very hard to contain. So, and then that's why salary negotiations could become very interesting. Great. Okay, let me continue with this. You understand what we're doing? Yes? Okay. So let me continue with this, and now I'm going to do some additional considerations. First, I'll have to explain a few things, how funds work. So, an offering memorandum is a document which is the only binding document. The investors are not in the room. If we were a bigger group, I would be having additional students act as the investors. I don't have that because it's only 5 of you. But if you have the investors in the room, we need to make sure that the investors are being served by what we're doing here. And the offering memorandum is the document that gives us the obligation to do things, and that's what the investors really buy from us. When they give us the money, they know that whatever is in the offering memorandum, we will have to do. So for example, the portfolio and investment guidelines. If we say we're going to do snow swaps, which are profitable, we can only do snow swaps. We cannot go and buy stocks. Not allowed. For example, fees, how much we charge, 1 and 20. Well, that would be in the offering memorandum. Valuation principles and methodology. This is very interesting. This is very interesting. Let me go back. We get paid 20% of the gains, right? For that reason, we need to value this portfolio. We need to know how much this, so we have to tell the investors how much the portfolio is worth. You do that. You are the one who tells the investors, you gave me $2 billion, your investment is now worth 2.1 or something like that, right? Yes, or 2.2. You have to calculate the value of the fund. The role of the administrator, which is a financial services company, is the one who actually has validity, not you. But I don't want to talk about that. So you are the one who calculates that. You sell that to the investors. We start this fund in August. In August, the investors gives us the $2 billion, right? You have to give them a statement of the value of their investment in September, in October, November, every month, right? So what would your statement look like? This is accounting we're talking about now. Accounting. Do you think accounting is fun? Accounting? It's great fun. It's fantastic. It's actually the most important thing. If you didn't know that, you would be convinced of that in my course. Accounting is so important. So in August, they give us $2 billion. And now I'm looking at you, you have to tell them how much the investment is worth in September. So what would you tell them their investment is worth in September? How much is this investment worth in September? Pretend to help you. Do you understand why we need to do this? We need to tell the investors because we need to collect 20% of that.
Well, maybe it's important to tell what will be return on their investment, and I would say 10% more.
You would say it's 10% more?
Yeah.
In 1 month, they have made 10%?
Let's say 5, between 5 and 10.
Okay. Anybody has a different answer? Let me continue. What would you say in October? What would you say at the end of November? What would you say in December?
Oh, right, I cannot say one rate. It depends how investment performs. So,
What would you say in January, in February? You have to report these numbers every month. You have never invested in a mutual fund, right? But you invested in stocks.
Yeah, actually, I invested in ETFs. So
Well, that's okay. An ETF is like a stock. It's not a fund. How did you know the value of your investments every day?
I look at price.
You look at price, exactly. You look at price, and then from the price you get the value of the investment. And everybody would do that if you invested, right? So why are you saying something different now? Why don't you look at the price? Why doesn't he look at the price? I'm going to someplace very important. Half of the courses that you take at this program have to do with this. Why doesn't he look at price?
Because it's not publicly traded.
It's not publicly traded. Our securities are not publicly traded. So we cannot look up the price. All right. Have you ever, I can guarantee you're going to have a lot of courses in this program that will calculate the price of financial securities. For example, you know this thing called option pricing? We will do option pricing in my course too, by the way. I will make sure you know option pricing. I don't care what others will tell you, I'll tell you. But why are we doing option pricing if he is waiting for the security to be traded, so you know the traded price and you use that to calculate the portfolio value? You understand what I'm talking about? So how can we calculate portfolio values? We can look at traded values if they're traded, right? Or we can look at calculated values if they're calculated, right? Which one is better? Tradable is better. If you look at the traded value, it's definitely better. Why would we look at valuation methodologies, pricing theories that you will see in this program? You will see this, you probably have seen already. You've studied option pricing already? So someone showed you how to price options, for example?
We haven't studied.
You have not done that? You have not done that? You have not done that?
Not in the school.
Sorry?
I've seen it, but not.
No. I know you just started the program. Have you seen that in another course elsewhere? You've seen option pricing?
I some kind of understand.
Sure. So you've seen that? Have you seen that? No? Okay. So you have not, which is okay. You're going to learn that with me, probably on Saturday. Probably, I don't know. But many courses in this program will teach you how to calculate the prices of certain financial products. It's called option pricing. But now I go back to your question, how do you value the swap? So I'll tell you a few things. I can guarantee you that in none of the courses you will take here, someone will teach you how to calculate a snow swap. I can guarantee you that. They will teach you how to calculate other option prices, although, okay, like call options, put options, barrier. I have no idea what they will teach you, but they will teach you how to calculate other options. Why do you want to know the price of those transactions, of those financial products? Why do you want to know the price of that? It's because on occasions you have to know what the price is, for example, to price the value of the investment. Like in this case, I wish I knew the value of those snow swaps in October and November and December, because I can give good reports to my investors. And the reports to my investors are very important. Why? To tell the truth? Yes, to tell the truth, yes. But also because we will collect 20% of that value. If that value is miscalculated, we're going to charge what we're not supposed to charge. In fact, let me ask you one thing. If it was up to you, Nikita, if it was up to you to determine the value of my fund, what would you prefer to do? What would you do? You will try to inflate the value of the fund.
Right.
You understand?
More.
And I'm not saying that you are a criminal. But if the value of the fund is determined by you, you will be encouraged to increase the value of the fund. Maybe I actually put in your contract. Now, in your contract, I give you a variable payment. Why? To encourage you to lie. This is the real world we're talking about. This is not what's written in a book. Do you agree? Do you agree with that? You're a lawyer. Why not? Maybe I encourage him to lie by changing the value of the securities, right? This is real. This happens. In fact, we're going to see examples where this happens. So in a good firm, no, I don't want to give you a variable. I don't want to encourage you to lie. You're going to make the amount of money that you make for telling the truth. And not telling the truth, I should not pay you for that. Understand? Okay. But how do you calculate, back to this issue, how do you calculate the value of a snow swap? We don't. We can't. So in the offering memorandum, there's going to be a section that says how we calculate the value of our securities. In this case, there are snow swaps. We say the value of the swaps is 0, always. 0. You may be thinking, wait, if it's 0, how will we make money? Well, we'll make money because when the swap ends, there's a payment based on the event called snow. And that payment is a cash payment. It's not the value of the swap. And this is accounting. That's how accounting works. The swap will always be valued at 0, but then the cash payment will be valued at cash. All of that will be written here. Because when you're doing securities which are very strange, the offering memorandum will have to say how these valuation principles work. If instead of that, we had in the portfolio some of the securities options, for example, that you will learn how to price in this program, that will be written there. Something actually as close as the theories you will learn, they will be part of this contract. So when someone teaches you option pricing, and I suspect I will be the first this weekend, but other people will spend a lot of time explaining option pricing to you. When they do that, you need to understand that this has tremendous implications. In particular, it has the implications that investors who invest in your fund will know how much their investment is worth. And not only that, 20% of that belongs to me. And if you do it wrong, if you lie, then what I'm doing is misappropriation, it could be embezzlement, and I could end up in jail. And it has happened. We may see examples of that. That's how important all these things are. And a lot of attention will be placed in FIM on something called pricing theory. And this is exactly what that is. Our example in class is so complicated that the valuation is 0. Because we don't know how to price it. By the way, oftentimes when I teach this course and I give this example, some people say, oh, I look at the window and I see there is snow. And then I value the swaps as a function of whether there is snow. You cannot do that. Because every evaluation has to be something that you can defend to a judge. You can be sued. That number is wrong. You have to be able to defend it. And you cannot defend, well, I looked out the window and it's not snowing, so.
But saying that it's worthless is also not correct.
Say that again?
But say that the swap has no value.
No. You misunderstand me. And now the lawyer will help me explain it to you. You're saying that what I'm saying is not correct. Well, it's correct if it's written here, but that's not what I said. What I said is that I can defend it to a judge. To say that the swap is worth 0, maybe it's correct, maybe it's incorrect, but I can defend it in front of a judge. The judge knows what 0 is, right? And if in this document it says that the swap is worth nothing, the swap is worth nothing. Because the judge will only look at the legal representations. You see? You understand this? This is very important because a lot of my students, they take courses in pricing theory, and oftentimes it just becomes a mathematical exercise. Pricing is very complicated, but I want you to understand the context in which all that pricing works. All of these things exist outside of the classroom. They have to make sense outside of the classroom. And the impact of pricing, very often, not always, very often, is to determine the cash flows that people are entitled to. How much my company makes, how much you will be paid for your shares, and this and that. And if I pay you the wrong amount, or if I charge the wrong amount, a lawsuit can happen. And a lot of these things are determined by a judge. Yes? So this is the relationship between mathematics and the law. Mathematics will give you the principles that have to be written in a contract. And because of that, when you look at mathematical formulas when they do pricing theory, I want you to do something. Just don't tell the teacher. They will be very confused. They will think you're crazy. But I want you to do one thing. When you see those formulas, always think how a judge will understand them.
What if a judge doesn't understand that formula at all?
They typically don't. They typically don't. Judges, they don't understand mathematical formulas, right? But those formulas could be written here. And then what the judge will do when you come to this is the judge will hire what's called expert witness. I've been an expert witness to judges. And the job of the expert witness is to explain the formula to a judge. And the judge says, okay, this is what the formula says, this is what they did, is that right or wrong? And then the expert witness will say, Your Honor, that's wrong. Or Your Honor, that's right. And then the judge believes you, and that's how, but the judge needs to have a process they can follow. So a lot of the formulas you will see know that they are part of a very important machinery which has to be trustworthy. Back to history. This thing I'm talking about is very new. It's only about 100 years old. 200 years ago, you could lie. You can say anything. It didn't matter. Lying in financial matters was allowed. So investors had to be very careful. You couldn't believe anything. That changed in the year 1933. In the year 1933, lying was punishable by the law. You know what happened in 1933? Why this happened?
Great Depression?
No. It was related, no. What happened is, in 1933 is when the law came up that fixed all the problems that had occurred before that led to the big crash of 1929. Have you heard the crash of 1929? 1929 doesn't ring a bell? No. You're very young. I'll mention a movie. Maybe have you seen this movie? Well, in English it's called It's a Wonderful Life. In North America, they show this movie on television every Christmas.
Oh, yeah, when bank run happened, right?
Yes,
Oh,
yes.
I think.
Can you tell them the title in Georgian? Maybe they know. I'm trying to connect your life to what I'm talking
I
about.
don't know the movie, but I know
James Stewart.
the
James
bank
Stewart.
run.
It's a very famous movie. Please find the name in Georgian. Tell them I need. It's called It's a Wonderful Life. James Stewart, and they show this movie in Christmas in the U.S. every year.
Wonderful Life, great.
Hmm?
Wonderful Life.
It's a Wonderful Life. In English, it's a Wonderful Life.
They suck.
It's an old film, right?
Hmm?
It says 1946 film.
Something like that. Yes, it could be. Yes.
I have not seen it.
Yes, and what's the title in Tennessee?
I don't think I found it in English.
Yeah, that's the one. Oh, you found it in English. Okay, so I'm not going to ask you to watch the movie, okay? But it will be an interesting exercise. This movie talks about the market crash of 1929. It was a very bad crash, very bad. That was actually the beginning of the Great Depression that you may have heard, which, by the way, was only solved with a massive bailout package called World War II. World War II happened because of the Great Depression. So bad. Okay, wars tend to fix financial problems. It's very bad, but I'm not going to talk about war, but it's a fact. And what was a lot of that market crash was because of things that were legal at the time. So 1933 made them illegal, and since then they haven't happened. And it's all related to that, and a lot of the math you're going to see is related to that. Okay, I'll tell you more examples. There's one which is very nice, but I'll tell you when, again, probably on Saturday, I'll tell you another thing that happened in New York about the law. It's very nice. But so let me come back to this. As I told you, today I want to summarize everything you will learn in this program so that you see how it actually finds its way into reality. Reality will be your job. That's the reality that matters to you, your jobs. Right? Okay. So there's a section in this offering memorandum which is valuation principles and methodologies. In our fund, it will be very simple, but in some funds, this can be very complicated. Oh my God, people who trade mortgages, the value of a mortgage is very complicated. A mortgage is a very complicated option, financial option. The value, not how much you pay, the value. Mortgages are bought and sold between financial companies. Here you go, this book of mortgages. Oh, they're great, they're very cheap, right? How do you know a mortgage is cheap? They're very complicated objects. They're all here, all right? Okay, so let me continue. Oop, again, what happened? I said I was going to fix it during my break, but something is wrong with my settings. And, okay, so liquidity provisions. Liquidity provisions talks about when people can take their money out. So you're my lawyer, and we are talking, you and I, and we're writing the offering memorandum. The offering memorandum, by the way, is written by you. That's why I pay you $1 million. And now we have to decide, you and I need to decide, when do we allow investors to come in and out of the fund? What if an investor says, oh, I'm Elon Musk, I give you $500 billion, and then they call her, my salesperson, said, Mariam, I need my money. Then Mariam comes and says, oh, Elon Musk needs his money back. And then we go to the chief investment officer and say, Gega, say, we need to send $500 million to Elon Musk. And you say, what do you say?
It's not possible.
It's impossible. It's linked on a swap contract. I can't give it to Elon. And then you say, Elon really needs it. He called me and he really needs it, right? So to prevent that is very bad. What do we do?
So So we lay out the plan in the beginning about when the money can be.
Exactly. So we tell Leland, you're giving us this money, but you cannot take it in. How long are these swaps? Did you say?
Have we said? I don't think we talked about that.
Say something.
Okay, let's say 10 years.
So we discussed this already. I can move on. We already said what's going to happen in this case. Okay, so let me now pose another situation. Let me just move here. Okay, so this is our fund. Remember that? It was very good. And I was making money. You were making money. And now, Mariam told us that our fund is so popular, everybody loves it. In fact, she knows of another investors who are coming to the fund. There's $2 more billion, another $2 billion want to come into the fund. What do we do? What do we do?
We find other investing opportunities.
There are no more. We have all 100 cities in North America. We're done. I have $4 billion. $4 billion. No more swaps, so we can make 200 million, but that's all, right? So let me look at this, because now Mariam is paid. How much are you paid, Mariam? Remind me. How much are you paid? What's your salary? What's your income?
We said from management pays a percentage.
I pay you 10%.
Yes.
So your income right now is 2 million, but if this new money comes in, you're going to make 4 million. So you will. What would you like to do? What's your preference? I'm the decision maker. It's my fund.
I
Okay.
should choose between these two, you mean?
Yes.
So more amount is better always.
So for you, your preference. Do you understand her position? She wants 4 million, right? So you say, yeah, we want that money. What do you want? I'll give you the full financials. We're making a little bit less money now on the performance fee because we have bigger costs. So we are only making $160 million net profit. So 20% of that is 32 million, which gives 128 net for the investor. The investors now only make 3.2%, but you make 4 million. And you make only 3.2. What do you want? You don't care, right? You're the lawyer. You make $1 million. It doesn't matter to you. What do you care? You don't care. You make $1 million. What do you care? You don't care. $1 million, right? But you care.
Yeah, I care too.
And you care. You don't want it.
I don't.
I said, you don't want it. And then what's my position? What do I want?
You want, you like this new
I like it.
arrangement, yeah.
I'm going to make $15 million more, $16 million more, right? Me. I'm the owner, right? But I also know that will be the last day I work. So I could think, imagine I'm 75 years old. I said, sure, I make $16 million, I retire and screw you, right? Imagine I'm 40 years old. I said, no way. I'd rather continue to make $45 million for the rest of my life than make $14 million more and then have to retire. Because when this happens, everybody knows. And then you are never going to have the ability to invest in a fund anymore. You understand? This is part of what goes into this. So, okay, so I think we've talked about this for a long time. I think it's probably time to move on. But just talk about death, and then I'll talk about other things that I want you to do. So death. There's many ways to die. One is fraud, The other one would be to what I did. It was not fraudulent what I did to accept that money. It's not fraudulent. I haven't done anything illegal. The investors will be unhappy. They will see how quickly they can take their money out, and they will never invest with me again. You make $2 million extra, good for you, but that's the end of it, right? And this is under death for me. And then a blow up is other things. I just want to tell you a situation that happened here. It was very famous. I don't know if you heard of this guy. He was very famous in 2009. Probably even in Georgia, people were talking about him. This is Bernie Madoff. He died. But before he died in jail. But before he died, this guy, he did two very famous things. He was one of the people who created the NASDAQ exchange. You know the NASDAQ exchange? Have you heard of that? That's the exchange where a lot of the technology companies trade. So he was one of the creators of the NASDAQ exchange. He became very famous, very knowledgeable, and then he created a firm, an investment firm that was very interesting. Because he was telling everybody he was doing these fantastic, very intelligent deals, doing this and that. I forgot what he claimed he was doing. And he was making a lot of money every day for a long time. Some people had alerted that what he said didn't make sense. Was people who know about finance alerted the investors in the world, said this doesn't make sense. This is not something that is possible. So the Securities and Exchange Commission, which is like the enforcement agency in the United States, visited him. They checked everything. He gave them bank records, gave them trade records, and they saw nothing wrong. So he was free to operate, and actually he was very, very famous. Every investor loved to invest in his fund because he was making, a lot of money every month. Now in 2009, this was after the financial crisis of 2008. 2008, people needed money, so they started to withdraw money from his fund. And that basically brought into the light what he was actually doing. What he was doing is something which is called a Ponzi scheme. A Ponzi scheme is an investment where you invest, I keep the money, and I say that your performance is very good. I say, you don't trust me, that's no problem, because he's invested already, gave me more money. So you want the money out? And I said, I made a lot of money. Sure, I give you that money, and I give you everything that I said I made for you, which is not really, I haven't made any money. I'm just taking your money to give it to you. So here, I will be calculating the value of the fund, but the wrong way. I'm giving the wrong information. So this thing we discussed earlier, that you had to calculate the value of the fund and telling the investors. So in this case, what he did is hire someone like you that paid very well, and you were in charge of lying to all the investors. But as the investors take the money and they tell everybody, it's right, I got my money back, look, it's all great, then he became very popular, and then you invested in me, and everybody invested in me, and when people wanted their money, I just give it to them because I was taking money from the investors. At the same time, he had enough surplus to take a lot of that money out of the fund, stealing, and taking it away just for himself. But in 2008, what happened? Everybody needed money. No one was investing. People were asking for their money back. And at some point, he said, I don't have it. And that was $65 billion that he had appropriated from investors. When he said, I don't have it. It was all a lie, so take me to jail now. He went to jail, and he died a few years after that. It's a very famous case. It's a very famous case because it highlights actually many of the things that I described here. When I set up my firm, I set it up in such a way that you were discouraged from lying. In his case, he set it up so you were encouraged to lie. And in fact, because I am so good, I created the NASDAQ exchange. Of course I know how to do trades. Of course I know how to falsify trades, which is what he was doing. So you falsify trades, I give them to you, and then you cook those trades to give to the investors a statement saying that they are rich. That makes me very popular. More investors come, and everybody sees that they're all becoming richer, but it's all fake, right? So it's a very interesting case because it highlights this thing I told you earlier. It actually happens, and it happens not only once; it happens a lot of the time. I have a whole course devoted to things that happened, events that were fraudulent in one way or another. So this is not an exception. This is sadly what happens. It's the nature of the beast. Anyway, I want you to know that there's many other ways to die. This is just one, which is very, was in the newspapers all the time. And perhaps my favorite way to die, my favorite way to explain how you can die is with another example. And this is what's called a blow up. And I want to go back to my snow fund. I want to go to the snow fund. Remember the snow fund?
Yes.
I had 100. Yes, yes, you work there. Yes, exactly. You are the CIO. And remember the snow fund? We had a number of, we had 200 contracts, right? 100 with cities, 100 with ski resorts, right? Mont Tremblant was one, Blue Mountain was one, Whistler was one. Okay, great. So we're very happy and everything is going very well. Everybody's paid the right way. We have all the right legal documents. It's all great. No problem. I mean, this is a great company, right? Your friends, your investors are very happy. You talk to them, take them to dinners and this and that. They're all happy. Everything is good. You invest your money. Your chief risk officer, so everything is good. Look, no risk. Great. And then on December 20-something, I open the newspaper and I see this news. It says, there was the headlines. How did Interwest rack up so much debt? And at that point, when I read that, my blood just goes away from my brain. So what's this? What's this? Turns out that you may not know, but I know Intrawest is the company that owns all of my ski resorts. It's a very big company in North America. It owns ski resorts. That's what it does. And all of our ski resorts that we had in our portfolio are owned by Intrawest. And it was on the brink of bankruptcy. So what happens to our portfolio? Now this is the question for you. Zura, what happens to my portfolio if Intrawest goes bankrupt? So this was December 24th, and I call you, Christmas Day. I said, stop whatever you're doing. What do we do? I call you. You're the one I call. I pay you $1 million. I pay you $1 million to call you on New Year's Eve and say, Zura, what do we do? What happens?
Maybe we are in a bad situation.
Yes, we're in a bad situation. Thank you for that. What's going to happen? What happens if Intrawest goes bankrupt?
We're going to have to pay those cities from our fund.
We all pray for global warming. Right? Or we pray for the opposite. What do we want? What do we pray for? Global warming or the opposite? I need you to understand financial markets now to decide what we pray for.
Global warming.
What do you think? Global warming or the opposite? Think. I need you to think. I want you to get this straight. Intrawest is going to go bankrupt. Oh my God. Now what? What do we pray for?
Pray for a sunny weather.
Did you see that? No, I think you see that. I don't think you see that. What do we want? What do we prefer? A lot of snow or no snow? What's our preference? What happens if there is a lot of snow? What happens? If there's a lot of snow, a lot of cities will have to be paid a lot of money. And that money is coming from?
Interest. Not from us.
Well, yes, but...
Investors.
Yes, from us, but We set it up so that we get the money from the ski resorts, right? The ski resorts, you think they will pay if they're bankrupt? No. They may pay for certain things, but not for this. This is very low priority on the capital structure of firms. We haven't talked about default, but we will at some point. I'll tell you about that also.
Is it
Bankruptcy.
lower than equity?
What?
Is it lower than equity?
Oh, no. Equity is wiped out. No, equity is the first to go, but this is very low. Okay, if they have loans, for example, those loans, bonds, for example, they will have security against them, so they will have to be paid first. But this is a swap without security, too. No, it's almost at the level of equity. Okay? So we're not going to get paid. And we have to pay the cities. What we want is the opposite. We want very warm weather. So we get a lot of money from the cities, and we give it to them. From a risk perspective, you want to be in a position where you pay the company that goes bankrupt, not the other way around. Understand that? It's counterintuitive, but that's who it is. You want to pay the bankrupt company. So yes, we want global warming. Otherwise, we'll be in trouble. Right? Damn, that we didn't realize that. Risk officer, that was your problem. You should have told us, right?
You should have known that every resort was owned by one company.
Exactly. By the way, I'll tell you something, because this links to something else that I'll be teaching you. There's a new way of doing risk management today. You're going to see risk management. I don't know who's going to do risk management in this program, but you're going to see risk management from the 20th century, which all focused on the value of this and the scenarios and this and that. These types of things is something for which ChatGPT is very good for. In fact, there are companies, and one of my students actually have companies that's what they do. They realize these risks because language models are the ones who can tell you that. They can easily find factors. All these companies, they all have the same shareholder. Is that important for you? So you will be the consumer of that. I'm looking at you because you are the chief risk officer of this firm, right? So this is an area where machine learning, AI, and all of that is becoming very important. It's actually changing our ability to understand hidden risks because they are hidden to us, but large language models, they are not hidden to them. They know them. Right? Okay, so we're in trouble. We're in trouble. Intro is going bankrupt. We're in trouble. And I have some potential financials here. Let's say that we're going to lose in some of the, not in all, but we'll lose in some of the shops. I just came up with a number that the investors are not going to make 200 million. They're going to lose 60 million, not very much. We still get paid $20 million. So even that year, I still make money. You make money, and I make money. You're the one who doesn't make very much money. You make your minimum wage. They're okay, $1 million. She still makes 2 million, 1 million, 1 million, but you make how much? Minimum wage. That's it. You're the loser now. You're the loser now. And my investors lose money, okay? But I don't lose any money. My company is still making money. Do you understand this? This is how the investment sector works. And this is something which is important to understand. Investment sector, banking sector, they always make money. Doesn't matter what happens, they always make money. It's good to take it into account. And now, so having said this now, what I want to do is I want to talk about risks, and that's a very simple description of, so it's 5:40. At some point I need to take a break, right? Do you want to take a break now? Let's do the following. We're going to take a 10-minute break, 10 minutes? We take a 10-minute break, and we'll come back. I'm going to give you some summary of what's going on, give you some labels to what's happening, right? And then I stop. Then I want you to take over. I'll tell you things for you to develop, okay? And then that's when you get to work. But 10 minutes, 5:50. Okay, great. So what I'm going to do now is I'm going to use all of this to reflect and then touch on another big area of FIM, which is risk management. But I will do it at a very simple level. I'll just talk about the risk taxonomy. It's the classification of the different risks that exist. Market risk is the one that everybody understands by risk, and it's the loss of money value due to changes in asset prices. For example, in our snow fund, when we thought of risk, we thought that we'll have to pay in our swaps to counterparties, and we'll lose money that way. It didn't occur to us there was another type of risk, credit, which is someone owes us money and they're not going to pay. Well, that's a risk also, and it's called credit risk, and it's a very big deal. Liquidity risk is when you have money, you have things that are worth money, but you don't have the ability of accessing those assets, so you can pay what they're worth. For example, if you're very rich and all of your money is in very expensive homes, you have no cash, you're very rich, but now you have to pay potentially even a small amount very quickly. Maybe the banks don't want to lend you money for whatever the reason, and you can be very rich, but you have to get rid of your houses very quickly and you will lose a lot of money. There was a case of this. This happened in London Capital Management is an example, but which I'll describe some other day. But there was a case of two of the wealthiest Texan brothers, the Hunt brothers, two brothers. They had cornered the silver market. They were very, very wealthy. And they got a margin call. We will see what a margin call is again in a few days. One of their assets was, for example, the oil rights to all of Alaska in the US, worth billions of dollars. Well, they had to get rid of that for a fraction of the value because they needed money very quickly. So that's a case. That's an example of liquidity risk. Gap risk and legal risk is the one that I'll describe some other time. I mentioned it today, which is bankers' trust. What happened to them with? But I'll describe this when I explain to you about options. And operational risk is a very general term, which denotes when you make mistakes, for example. So this is the risk taxonomy. There are more. And it's important to understand all these risks because in these risks, and this is the part that I want you to understand, this is the only important part of this slide today. There's two types of risks. These are risks that you take and you get paid to take those risks, and risks that you take and you don't get paid. Before I go to the financial sector, when you go in a car, you put the seat belt on. It costs you nothing. And if you have an accident, that may save you. So if you don't do that, if you do not put the seat belt on, that's a risk you take, and you don't get paid for that. It's a risk that you take for free. But if you drive a car and you go very fast, you're taking a risk. But you get paid for it because you arrive sooner, you win time. Yes? It's always like that in every aspect of life. Every risk you take, sometimes you get paid for that, sometimes you don't. In finance also. So of all these risks, market risk, you typically get paid for that, almost always. You buy something, it comes down, but if it went up, you would have made money. Okay, so you get paid for taking that risk. Credit risk, sometimes you get paid for that, sometimes you don't. Oftentimes, people don't get paid for credit risk because they are not even aware of that. Example, our snow fund. If we had known about the credit risk, we would have perhaps made money from it. And I'll show you now ways in which we can do that. We can make money.
So you fired him?
Sorry? I don't know. Okay, so I want to spend some time talking about credit because I want to teach you how to distinguish between risks that you take and don't get paid and how you can charge for risks that you take. And similar, liquidity, typically you don't get paid for that, although there could be a liquidity premium and then you get paid for that. And the same with everything, okay? But these risks are typically risks that you take for free. That's a bad idea. If you can figure out a way to charge for them, then they may be a good idea. Okay? So for that, I want to have a conversation. I'll go over this. And I want to discuss, I want to go back, and I will end with this today. Okay, this is the last thing I will do. We'll be finished by 7. I want to take this, well, you will see what I do. I want to go back to our conversation, and I want to pose a question. Let's go back to the snow fund. Let's go back to the original deal we started at the beginning of class today. When you're talking to the city of Montreal and say, wait, don't do the deal with the ski resort, do it with me. And then I said, how can I trust you? I said, well, I have the money, I have $20 million here, right? And then they trusted us and then we did the deal. We were not smart. In fact, if we had done it like that, it would have been a mistake of whom not to do the following. So I have the money. Where's your money? Where's your money? I put my money down. I was dumb. I didn't ask for their money. Right? Right? So this would have been perhaps you, more than him. Or you, the lawyer, that should have said, what? Where's their money? That's why I pay you the big bucks, right? Then we could have, maybe we should have structured that deal differently. Maybe we should have structured the deal by saying, well, here's my money, where's yours? So, okay, let's both agree that we're going to put it in some place. So if you go bankrupt, that money's there. No one can touch it. And then my risk of default, he will be happy because my credit risk suddenly is lowered because I have collateral. This is what that money is called, collateral. If something happens, I have that. When you get a mortgage in a house, the house is collateral. You don't pay the mortgage, they tear the house, right? So the use of collateral is very important in financial transactions. So I want to explore collateral now in two ways, because imagine I ask for collateral. I said, no, I'm not going to give you any collateral. I said, well, you don't give me collateral, I don't give you collateral either. And then we start in a negotiation. And that's how these things actually work. But for them to work, you have to be aware. And at this point, it's all about being smart. I cannot tell you it's about this or that. It's about being smart. It's something which I always like to, when I teach, especially to the mathematicians, it's not the math you know, it's how smart you are. That goes with the math. So I'm telling you, in the financial sector, you have to be smart. Okay. Do you want light, or you're fine with this?
I'm fine.
You're fine? Okay. All right. So let me So let me look at the deal now from a different perspective, knowing that they can default, we just saw that. And we can default, we always knew that, but we didn't want to, we want to be very nice. No, I have the money, I have the money. So imagine now all the possibilities we have of structuring a deal and potentially make a huge amount of money just by being smart. Just by being smart. Imagine the negotiation with them, where we say, where's your collateral? Say, no, I don't want to give collateral. What would be our response?
For me?
Yes, you're the portfolio manager, so.
And I won't do business with you.
No, okay, yeah, okay, so that's an answer. I'll propose something better. I say, okay, how about this? You don't put collateral. I'm just giving you, I'm not saying this is a good idea, but I'm telling you something, and I want you to tell me the consequences of that. You say, okay, you don't put collateral. That's okay, but now I don't put collateral either. I say, oh, no. I say, well, how about this? I put half of the money as collateral. I put only $10 million as collateral, not the full 20. You understand what I'm saying? What would happen if I do that? What would happen if I do that?
I will encourage the other party to also put a collateral in terms of like half.
It's agreed. They put zero collateral, we put 50% collateral. Let me ask you a very specific question. What's the performance of our fund if we do that?
That money probably earns interest, right? The collateralized money that we put up.
Okay. Follow my logic. Okay. I want you to think of this. I have it written here, but I want you to think. If I put only 10 million per swap, how much money do we need to raise? Half. So 1 billion is enough. So imagine a situation where I tell Mariam, raise 2 billion, or 2 billion, I can't. I can raise 1, but 2 is too much. Then maybe what I do is, 1 billion, sure. Gege. Gegan. Gega.
G-E-G-A.
G-E-G-A, Gega. Okay, so I tell Gega. See, it's your responsibility that I learn your name. Gega. So I tell Gega, we have 1 billion only. So go out there and now convince them to do a deal with half collateral. I don't care what collateral they put. I know we're taking a risk, I know that. But I only have 1 billion. So maybe I can use that and then get the deals. Right? Okay. Let's say that you succeed. What's the performance of the fund?
20%. We're going to get 20%.
We're going to get roughly 20%. You see why? Because the 200 million expected profit is the same. But I only have 1 billion. So we're in the reverse situation where I have less money that I need, but I figure out a way to get my deal done. By the way, in this situation, not how the compensation works. You get your million pay. You get your million pay. He gets his million pay. How much do you get paid? The same. In fact, a little bit more. How much do you get paid? Now you get paid 1 million, you're 10%, right? Are you unhappy? No, you are very happy, because before it was 2 billion or nothing, right? You only get me 1, say, I figured it out, I can do it. So in this case, you win, we all win. Now, bad thing is, we didn't have collateral from them. So this thing we learned about the intra-West example, we know it's still a risk factor. And we know that there's some risks. They will have to see how we mitigate that. I'm not interested in finding the full solution, because there's no such thing as a full solution. I just want you to be aware of all these things, because that's how deals get done. But by now you have so many variables that you can control. You're aware of so many things that I think by now, if I release you out there into the wild and you can get financial deals done, you can get very good deals by remembering this example and learning from this example. This example is very good. It really is very, very good. Yes, because everything we can learn from it. Yes? Okay, well, okay, I don't know if you agree. I know you're tired. We didn't have 8 hours of lectures. We only had, less because of my flood and my everything. But it's very tiring to do this for a long time. I know that. Okay? But still, now I want you to feel powerful now. With everything we have discussed, If you understood most of it, not everything, you should feel very powerful. You understand risks, where it comes from. You understand how you make money. You understand where money is coming from. If something happens, you know how you can reposition yourselves and you still do the deal, right? Tomorrow I will focus on the math we need if we want to do all of that at professional level. Right now we're only learning, but you're already very powerful. I need you to feel powerful now, because what you have learned, okay? And I can guarantee you that if you remember what we talked about today, in most of the courses and lectures you will get here, by linking them, if you manage to link them to this example that I now know you understand very well, I beat you to death, you will learn a lot, even in the other courses when they teach you about this and they teach you about that, okay? You will see. Okay, so here's the exercise that you can do. You can do this, just as a warm-up, right? So we initially we said we do $20 million contribution per swap, $2 billion total, right? And then we know what we get. We went through that in detail. Let's say that we can do these swaps with less than 1%, less than 100% collateral, and don't make it 50 like we said earlier. Make it X. X could be 70% or it could be 0%. If the lawyers of the city and the securities are stupid, maybe we can do these deals with nothing, right? Mrs. Lawyer, right? What will happen if we can do these deals with nothing?
So would that mean that our cost?
Mm-hmm. If we can do these things with nothing, suddenly Mariam is released of her, I can't, even $1 billion is too much, Investors are very afraid and I can get only 500 million. That's okay, 500 million. I say, well, these are stupid lawyers, team up with her and go against them and just get me the deal for whatever you want. And then when you do that, not only you get your deal done, you actually increase the performance. Right? Do you understand this? You understand this? Okay. All right. So, and what I'm suggesting here is that you can call that number X, and you will see how what I would like you to do, just to practice, just to warm up, I need you to do something so that you can assimilate. Make sure for me that you assimilate all of this. For sure. So, which is, I would like you to do this exercise. Call X the percentage that you are required as collateral. X1 corresponds to 100% collateral, as we discussed earlier today. 0 means no collateral. X is somewhere in the middle. And I would like for you to calculate, it's a very simple calculation, but I would like for you to do this calculation for me, which is, what's the percentage of your fund if X is between 0 and 1. Get me the graph of the performance. Okay? It's an exercise I ask you to do. It's written down, it's coming up. But there's additional benefits to this, which is, imagine another situation where, and this could happen too, again, I want you to be smart. Mariam, you're the seller. You go out there and said, I can only raise 200 million. That's all I can raise. Damn, I don't like to give up. How can we do this with 200 million only? I tell you, go and see if you can negotiate with 10%. And you go, said, I can't. If the best I can do is 20%. At that point, maybe what we do, we go to a bank. I said, I have 200 million, I need another 200 million. Can I borrow it from you? By the way, who does the borrowing?
Management. Management firm.
No, the management company will never get a loan from the bank. The fund will do the loan. See, we mentioned the bank when I give you the whole structure. There was the bank there, right? But back then the bank was the one that was just going to hold the cash. But now the bank is going to do a service that banks love to do, which is to give you loans. That's how they make their money. But they don't like to just say, give me money for whatever, I don't know. When you go to a bank for a loan, they typically look at what you're doing very carefully. And in this case, they're going to have another risk manager just like him on the other side. And another lawyer just like you on the other side. They said, show me. And then you show them. Then they're going to do their own calculations. And then they're probably going to say this. They're probably going to say this. You have your 200 million in the fund? Great. You need 200 million. Okay, I'm willing to lend you only the other 200 million on this condition. The first to lose is the fund. The bank will lose after the fund has lost everything. Understand what I'm saying? That's how banks will typically do these structures, right? They get first access to the money. Whatever is there, they will get. Their receivables, all the money coming from the swaps, they keep. They keep any cash in your account, they keep everything. The first money which is lost is done. And in that case, they will do their own risk calculation, which I will show you. We're going to review that in one of my lectures, how the bank will think. And they're going to see that it's a good deal for the bank. So suddenly the bank has a business in this also. By the way, they save our business too, because you could only raise 200 million. The bank will give us what we need, 400 million. Now you can do your swaps with a 20% collateral, and we're saved. Yes? And by the way, in this, who has the best business?
Bank.
The bank.
No risk.
They will do that so that their risk is very, very low. I don't know if you understand what I'm trying to tell you. We are recreating the whole financial system. That's how the financial system works. And I chose this example of the snow swaps because, I don't know, I've been doing that for 20 years. I know it so well. But that's how banks, I'm sure things like that happen in Georgia today. I am sure. What we're missing is perhaps no one had such a sophisticated idea as we had to make this snow swap a very complicated instrument. The way we diversify across. I would love to know. In fact, it's almost an assignment I would like you to do. I would like for one of you to know, to find out for me some business case that happened in Georgia, probably in the field of agriculture, which is similar to this. I am sure there must be a great example that already happened in Georgia, a business case that already happened in Georgia, which is similar to what I'm describing for you here. You understand what I'm saying? I am sure, and I would love to know. I mean, I can ask ChatGPT. I think ChatGPT's ability to know the Georgian history is very limited. Maybe you have a better way. But anyway, I'm posting it out there because if you had it, if you can find something like this, I would like for you to write the business case and I'll help you. And then we become famous in Georgia. Because this is financial engineering at its best. You understand what I'm saying? I don't know if you understand. You're tired. I know you're tired, okay? But I'm trying to squeeze the last juice out of you in the last few minutes of my lecture today, because this would be fantastic. You've learned so much today. I know that, right? And I want you to feel powerful, but also if you can do something with regards to that, it'll be fantastic, okay? So anyway, we're seeing how the banking system comes up, okay? So we went through that. And this is my, sort of extreme case. Can we do this without money? Well, that's a bit extreme now. We have far more interesting considerations. But this is the exercise I would like you to do. It's a very simple Excel. You can do this in Excel. Very simple Excel. It'll take you, it's, 4x3. It's very, very simple. You just take the finances that we had earlier and you modify them. I would like you to do this to make sure that you understand what we're doing. Okay? But more important than that is, this is what I want to talk about. More important than that is I would like for you to see how all of this can be extended. There's a very interesting exercise. I don't want you to do this one. Maybe I will do this at a later time when we talk about credit ratings. Because that's another thing has not come up. But credit ratings could be part of our discussion now. As you know, credit rating is essentially the rating that tells you the probability of default. We will see that. We will see that. I will lecture you on that because it's very basic. It's something that you have to know. And I want you to learn my way. But this could lead to credit ratings too. So we now get the credit ratings business also as part of what we're doing here. Okay, but I don't want to do that. I don't want to do that either.
Part of consulting that you mentioned earlier.
Sorry?
The credit ratings.
Yes. What?
I think I was wondering if these credit ratings are part of this sphere of consulting, for example, that you mentioned earlier.
It's financial services. Financial services. Yes. It's a very specific. It's not consulting. It's a very specific type of financial service. We'll discuss this in great detail. I'll tell you how these things are done later, not today. Okay? But it's something. It's probably familiar to you, and it's something that is related to this. So, so this is what I would like you to do, and this will be very. So I would like for you to see if you can find other situations that capture some of the things that we have in our mythical example of the snow swap that actually happen. If they're in Georgia, even better. And if you can find them, find what's the value proposition, who are the actors, who wins and how much, and what the risks were. This will be a fantastic business case if you can do that. We'll write it, we'll publish it, it'll be great. And it'll be great, we can do that one for Georgia. We'll get KIU to fully support it and send it to the president of the country. Or what do you have here? President, Prime Minister, what do you have here? Prime Minister. We said to the Prime Minister. Yes. I'm not exaggerating now, I'm not kidding. We do the good case, he will go to the Prime Minister. Yes. Okay. And when you do a business case contains two parts. One is the factual part, the one where you do investigative research. You have to find what the case was, what happened, who are the actors, details of the market conditions, the parameters, the variables, what interest rates, or how much snow we had. Okay, and then people's opinions, controversies, the status quo. People thought it was impossible. That's the description of the case. It starts with that. But the interesting part is not that. ChatGPT will do that for you, by the way. ChatGPT will do that for you. The interesting part is you. The part about you. What you would have done differently or similarly. What you think was right or wrong. And other considerations of yours. Okay? All right, so...
tomorrow?
No, hold on. So, this course has a marking scheme. I have to give you a mark. And according to what I submitted, I'm not sure, there's 3 pieces of work you have to do in this course for the mark. I forgot, a midterm, final exam, and assignment, or something like that. Yes? Something like that. I can look it up, but I suspect you have an official form where this was reported to you. I have it. Do you have it?
Not yet.
No, but you will have it. They're probably waiting for my okay, which is of course okay. Yes, I did it last year. It took me a long time to understand KIU. Let's see, I changed it so many times last year, but now I know what I want. So the proposal I have for you, and this is a proposal. I'm not going to respond until you tell me. The proposal I have for you is that there's 3 pieces of work that I want you to do. One is and I forgot the names, final midterm something. But one of them, I would like it to be this. Something that you write. that if you do it well, we'll publish it, and the whole Georgia, it will be on television. I will propose that. And then, of course, it's not due for tomorrow, it's due whenever the term is. Oh, no, they have a rule here. I have to give you a mark before you're allowed to write the exam or something like that. So it'll be like the day before, okay? Whenever that is. Doesn't matter to me. As you can see, I don't care about marks. I'm not motivated by marks. Marks are a waste of time. But they are required by the system. So I'm on record, I said that, okay? Don't care, I don't care. I have very little respect for marks. I have a lot of respect for success. That's the only thing that matters to me, success. Not always correlated with marks, right? If you can do that, that'll be great. And I would love for this to make an attempt, see what you can find. I didn't do that last year because I didn't know enough about Georgia, but I learned enough about Georgia last year. This year, I think I have a glimmer of hope that something like this could be done. That you can find something that happened, a case, where you can bring some finance like we did here. Who would have thought that cleaning snow in the city of Montreal will help us redevelop the whole financial system as we know it today? With nothing. Well, the insurance sector didn't show up, but I could, if I had 1 more hour, I could do it. Right? In fact, what we did is actually an insurance policy. I could rewrite this as an insurance policy. Do I have your permission to include that as part of the marking scheme for the course?
Like sort of a research paper.
It's like a paper, yes. Which, by the way, you're supposed to make very heavy use of ChatGPT. All the investigative thing has to be done by ChatGPT. But then you think, you're going to use ChatGPT also to think, but you think, you tell me what you would have done differently. Good, yeah?
Yeah, I like it.
Good. And then it's your own, you'll have your name, and we'll make an attempt to publish it. Fantastic. Fantastic, okay? Anybody is here afraid of being famous? Some people don't want to be famous. I don't know. Where are you? Are you like famous? Yes? No? No? Good? Famous? Yes? Good? Yeah? Famous?
Yeah, I like.
Yeah? Good. Okay. So then that will be your assignment. Just check.
Can we like?
No, nothing else. So Google me. You'll find me right there. All my great pictures. That's my website. My website contains a lot of things, but the important part is here under teaching, KIUFIM. Okay? That's yours. You can go to the others. Some of the others require that you register. Just register, pick a password, and then you can go in. Some of those are behind. I don't want robots to access some of these courses. The reason is in some of them I talk about famous people. And I don't want robots to, when you look for Cristiano Ronaldo, suddenly my web page comes. Do you know Cristiano Ronaldo? Do you know this guy? Yes, okay, so I talk about him, okay? So I don't want that. But this one, I think the one is free. So this is, what you see here is the website that I had for the course last year. So this is going to be different. So right now, for example, the first thing I'm going to do when I get back to my room is this, which is the lecture for today. It was slightly different today, so I will change it to today. And then you can download, okay? And it's the same. The final one will always be there after I lecture, not before. Some students, they like to have them there before because they like to follow while I lecture. If that's the case, then tell me. But typically what happens is when I lecture, I realize mistakes that I make. Sometimes you don't realize, but I realize. And then I like to go back and fix them. And that's why I like to upload only after my lecture. But what you have there is very close. It should be good enough. If you want to follow my slides, you can follow them. You can follow last year's. Okay, they're going to be somewhat similar, but not to worry. So this will be updated today. Give me half an hour, get back to my room, and then it'll be updated. I already have it. It's just a PDF version of what I did today. I don't use PDF to lecture. It's all there. Then you have additional lecture notes. This is from a course that I teach in Toronto. They might be useful. I don't know. I just put them there. The courses in Toronto are very well structured, and I have YouTube playlists for all of them. All of my lectures are there. This course I'm teaching here is different. It's structured differently. I don't have a YouTube playlist. Last year, I created one, but a lot of when I teach here, my courses are too interactive with you, so they are not so good for a YouTube video. In Toronto, I have 100 people, then I talk, but here, since it's small, I like to talk to you and this, and then it's difficult to do a video, right? So I don't know what I will do this year. You have videos of others that might be interesting, and then, so this is in case it's useful for you. But the important part of the notes, those are there, will be updated in about an hour, and they're yours to download and to do whatever you want. Maybe what I can do, if you want, no, I'm not going to do that. I was going to say I can do a formal description of this assignment that I want you to do, but I don't know if I want to do that.
I think that slide kind of.
The slide is already there, right?
Yeah.
Yes, exactly. I think that's all that we need. But I want you to. This is the most important part, I think, for you in this course. Okay, this assignment. If you can come with something very good, and I'll help you because this is not done enough. Then we can make something very, very good. And I would love for KIU will promote your work. I know that, because this is a program that is starting, and they want to promote this program, like they promote their students from last year. That's the part that I didn't learn last year. I learned it throughout the year. I said, oh, we can do that. You understand what I'm saying? Yeah, be famous.